Sounds good. Deepak, hi, sir.
रेशमा आहे माझ्या मते.
Reshma,
हाँ सर.
live जायचं.
लाईव्हच आहे
नाही.
आपण.
लाईव्ह सर.
वी कॅन स्टार्ट, काय प्रॉब्लेम. एक मिनिट, प्रमोद सर कुठे गेले?
I'm there only.
Okay. Kaishinath, you may start.
Good afternoon, all of you. Welcome all of you for this company law series. Today we have CA Pramod Jain. He is hello. I am audible.
Yes.
Today we have our CA Pramod Jain. He is commerce graduate from the SRCC. He is fellow member of ICI and also member of company secretary and Institute of Cost Auditors. He is also member in All India Management Association. He is also in insolvency profession. He is also passed in proficiency self-assessment test for Independent Director Data Bank. He is passed certification course NCFM of National Stock Exchange of India. He is also done certification course of ICI. He is also done post qualification course on valuation of ICI. He is our current Central Council member for the period 2019-21. Apart from being member, he is more than 25 committees group directorate of ICI. He is chairman of Valuation Standard Board and CSR Committee of ICI for the year 2021. Member of ICI Disciplinary Committee Bench 1 for the year 2021 and Vice Chairman of Direct Tax Committee for the year 1920 to 21. He is also nominated as a member of Quality Review Board for 3 years. He is conceptualized of the portal www.expertpanel.in, which is one of the best solutions for all professional queries, which have been given more than 20,000 answers since its launch in mid-year 2008. He has delivered more than 1,000 lectures and articles for various topics of income tax, corporate law, LLP audit, peer review, quality review, etc., at more than 150 forums throughout the country. Most of his presentation and articles since 2013 are available free download from www.lunor.com from 2018. He is also senior partner in Messrs. Lunor and Company Chartered Accountant. He is president, founder, convener, and member of various associations, committee, circles, committee, etc. of ICI, and other prestigious bodies and associations. He has been member of Financial Reporting Review Board, Audit and Assurance Standard Board, Auditing Standard Board, Taxation Audit Quality Review Board, Ethical Standard Board, Editorial Board, Valuation Standard Board, and Internal Audit Standard Board of ICI. He is technical reviewer of FRRB and Quality Review Board and peer review board. He is authored books of various books for professionals. He has written various articles in taxation and company law and in audit and control. His vast practical experience in taxation, audit and corporate law field, and he has been giving consultancy to various corporate and non-corporate entities on taxation matters. We have pleasure to have sir. Now I request the Abhishek to do the speech. Abhishek, over to you.
Abhishek, is it audible?
Abhishek?
I suppose Abhishek ji has some network issues.
Yes, Amruta.
Yes,
Yes, you are
Abhishek.
audible. Yeah.
Yes. We request you for the opening remarks.
Okay. Pramod sir, thank you so much for joining us. Uh, uh, as rightly told by Kashinath, his Central Council member, and we have pleasure to have you, sir. I remember when I was treasurer at Pune branch in 2017, you had been there for a company law refresher course, and we thought we felt that no one can replace your session in regards critical uh, aspects in finalization of the audit. So thank you so much for accepting our invitation. We welcome you to Pune branch. Sir, as you are aware, this is the third day, followed by your session. Aniket Bhai would be taking session on FRRB, common errors. What are the common errors recognized by FRRB? And I'm sure members would be benefited by your session. We once again welcome you to Pune branch, and we hand over to you, sir.
Thank you very much, Abhishek ji. Abhishek ji, chairman of the Pune branch, Kashinath ji, the secretary, and Amruta ji, and all other managing committee of the Pune branch, and all my friends in the Pune branch. I thank Abhishek ji and others for the whole managing committee for giving me an opportunity to share my views on what Pune branch has been doing since past many years. What I feel, so a 3-day refresher course on company law and a few days on direct tax also. So you have been doing this refresher course for the benefit of members. So in this series, on the last day today, first session is I would taking, and I would be in certain cases asking few questions also. So you can just type your answers on the chat box, right? So when you type in the chat box, I'll try and see that and then revert back to you, right? So going straight forward with my presentation, I'm just sharing my screen. Finalization of the financial statements. We'll be talking about entities other than the Ind AS, the companies which an SMP firm normally does the audit of and finalize the financial statements thereof. So we'll be discussing about that and not the Ind AS ones and its audit report of it. So what is the process of doing an audit? What is the process generally which you follow in doing the audit? Tell me what you are doing practically. In a brief, say 1 or 2 lines, you can type your answers in the chat box. What is the process in brief in a line or two which you do for the ultimate audit? Anyone can type in a line or two. What is the brief process? And I welcome our chairman of the CLCGC and a very dear friend Chitley sir from your own city, Pune. And thanks for inviting me, Chitley sir.
Sir, our pleasure to have you with us.
My
We were
pleasure,
expecting to have physically, but now at least this is the one available mode.
Yes, so nice, so nice.
Yeah.
So yes, I'm just waiting for the
since
answers.
Since you are also vice chairman of Direct Taxation Committee, there is also representation being made that for 1920, if the due date can be extended beyond 31st July, if you can make representation, that also may be considered.
Okay.
Assessment year 1920. Yeah.
I got it.
Yeah.
I got it.
Okay. Thank you.
So the answers which I have got is audit planning, audit execution, documentation, checking the transaction of the entity, cutting cut-off testing and compliance checking, sonology, that was from Akshay, and this is the knowledge of the business, appointment, initial discussion, planning. Okay, so all are going in the right direction. Let me put my own way of saying that. I am putting my own way in saying that how to go about it, right? I would say another. Let me ask another question onto this. Now, suppose which I've asked earlier also when I came to Pune, that suppose you are a manufacturer, of a product. You are a manufacturer of a product, and you process that material and what is our finished product? First finalization of trial balance, then trial balance will check. That will be the process. So what is our final product when we do an audit? Audit report. Nirmal ji saying, Joshi ji, the question was not audible. The question was basically just like when you manufacture, you process the raw material, and after processing the raw material, you produce the finished product. So in the case of audit, what is the finished product? So I've got a few answers. Final audited financial statements, opinion, audit report, issuing audit opinion. Yes, audit report, trial balance will be converted into financial statement, which can be understood, opinion. Yes, our final product basically, is the audit report. And yes, the problem I would say with our profession currently is that in our case, the beauty is that the final product is always ready before the raw material. What happens is that we do the audit, as soon as the balance sheet is finalized, we say audit is done. And if some client says, "Arey bhai, audit report kya hai?" Acha ab to bhul gaya. Just give me a few minutes. I say, okay, I instruct my colleague, okay, जरा पिछली report निकालो, जरा report दो. वो report में date change करते हैं, year change करते हैं, and then issue the report. कई जगह जो audit report में changes होने होते हैं, the changes which are required, like last year I had no fixed asset, this year I had a fixed asset, I don't change it. Last year there was a loss, this is a profit, we don't change it. We need to take care of our final product, that is the audit report. The process, in my view, is of course when we say starting with the financial statements. When the financial statements are there, then it is my auditor's report, and then it is the director's report, right? So all these are based upon this only. You know, when I talk about the annual report, you know, in the common parlance, when we say an annual report, what does that comprise of? You know, for anyone, an annual report that would comprise of would be the director's report, auditor's report, and the financial statements. Please see that whenever an annual report is to be issued or to be circulated or to be given to anyone, it should contain all these three. If it is not there, again, there is a penal provision under the Companies Act. There is a penal provision under the Companies Act. And we all know that, yes, financial statements, these are the basics. Based upon this is my auditor's report, and based on these two is the director's report. So we all know about all these things. So I'm not going into detail, but yes, what does financial statement further consist of? It consists of my balance sheet, my statement of profit loss. In case it is an Ind AS balance sheet, the statement of changes in equity, if any, and the cash flow. And the most important is the notes to the account. Now, this is so important, and I'd like to put some time onto it, because what I've heard, you know, whose responsibility is it to prepare the financial statements and notes? Whose responsibility is it? I know everyone knows the answer. My voice is low. The management, right? Everyone says management. Everyone knows it, but we have seen in various places, even in the case of listed companies, where in the notes when you are writing, when the management is writing, they have said, this is the point which we have said and the auditors have agreed. So how does that come? Or whenever we talk, some question is asked by our colleagues, what do they say? they say, okay, sir, this is the issue, what to do? You tell what should be done. They said, okay, we'll put in the notes. Okay, just the view of the auditors cannot be put in the notes. The auditor's product is only the auditor's report. We should be very, very careful. Sometimes when we talk about even ICDS, they say, okay, ICDS is there. So where to disclose its policies? So say they in the notes to the accounts. How? Because ICDS is not for the purpose of maintaining the books of accounts. So I have to be very careful in preparation of notes to the accounts, whereby I have to be very clear that it has to contain whatever the management wants to, right? Now going further, let us go to few critical issues in the financial statements itself. Going for the financial statements, of course, financial year, everyone knows for a company, it has to be 31st March. In rare of the rare cases, it could be different if they take the approval from the RD to have a different financial year. And the reason we all know that if that the other company, this Indian company is a holding or subsidiary of a foreign company, and for the purpose of consolidation, that foreign company is having a different financial year. So this company can also apply to RD to have a different financial year. Otherwise, every company will have a financial year 31st March. Cash flow is mandatory for all except the one-person company, the small company, the dormant company, and startup companies with effect from 13th June 2017. And yes, startup companies, we should be aware that these startup companies are the companies which are registered as a startup company with the DIPPT. Not because in Pune, it is a software city. So some new entrepreneurs, they come, they say, okay, we are a startup company. In Delhi also, they are coming due to NCR, other places. They say, we are a startup, we are a startup. No, startup, they may be starting a business, but they would not be a startup company unless they are registered with DIPPT, right? Yes, of course, the format has to be, the financial statement has to be in Schedule 3. And this Schedule 3 was amended to include the MSMED details under the trade papers. Now let us just understand in a minute that the whole financial statement, that is balance sheet, is to be classified into current and non-current, right? Current and non-current. So we'll just rush up through the definition which is given, because whichever is not a non-current, that is whichever is not a current is a non-current. So what is current? Current has been given defined under the general instructions to the Schedule 3, which says that current asset is an asset which satisfy any of the following criteria. That is in the company's normal operating cycle. We all know what is the operating cycle. In the common parlance, it is said cash to cash. Cash to cash means you have got cash, you procure raw material, you process it, you sell it, and then you take the money back. So converting back into cash, that whole process is operating cycle. Normally, for certain entities, it could be certain operations, it could be more than 12 months, like liquor or rice, but normally otherwise it would be 12 months. So in the normal operating cycle, it is intended for sale or intended to be consumed. Intended for sale is my finished goods, intended to be consumed is my raw material, expected to be realized my trade receivables, held primarily for the purpose of being traded, which is stock in trade, and expected to be realized within 12 months after the reporting date, my advances and other things. So the crux is in the cash and cash equivalents. The crux is if it is convertible into cash and cash equivalents, then within the 12 months from the reporting date, that is my current, other is all non-current. And similarly is the definition for current liabilities, which satisfy any of the following criteria. That is expected to be settled in the company's normal operating cycle, or held primarily for the purpose of being traded, or which is due to be settled within 12 months after the reporting date, or it doesn't have the unconditional right to defer the settlement for at least 12 months. So basic definition of current asset and current liabilities we are aware of. We'll be testing few cases when we are going forward, right? certain general points is that what do we title the balance sheet? Balance sheet we title as at or as on. What is the title of the balance sheet? As at or as on? Balance sheet as at. So Abhishek ji, the chairman sir says yes, as at. Ulhas ji says, everyone says as at. Why
Chairman
not
is
as
always
on?
right. Chairman is always right.
Right, sir. Right, sir. So why not as on? Because as on is actually on a day. As at is a particular time, the closing business hours of the day. So yes, everyone has got that correct. So if someone is writing as on, kindly change it. Further, the title of the profit loss, of course, it has to be statement of profit and loss account. And in the case of Section 8 companies, it has to be income and expenditure account. And rounding off is based upon the turnover. And the rounding off has to be, if it is less than 100 crores, then to the nearest 100,000 lakhs or millions or decimals thereof. And more than 100 crores or more, to the nearest lakhs, millions or crores or decimal thereof. In this case, for the non-Ind AS balance sheet, rounding off is not mandatory, it is optional. But once you round it off in the balance sheet profit loss, then it has to be for the whole financial statements, including notes to the accounts. It cannot be that in the financial statements you are rounding off, say, to lakhs or hundreds, and in the notes to accounts you are giving the full amounts. It is not allowed. It has to be throughout the financial statements. So please, because I've seen certain errors in this case, so this is not allowed. So comparative figures are required to be disclosed for the last reporting period. You know, you may be saying what is Pramod saying, this is a very, very simple thing. But I've seen, because when the corresponding figures, I've seen certain financial statements of the companies where my friends have told that, okay, we are just giving 1 year's figures. We are not giving 2 years figures. Why? Because we don't want to give it to the income tax authority. But Schedule 3 says comparative figures are to be given. I'm talking about smaller towns where it is happening. Yes, unless it is the first year, it has to be comparative figures. But the crucial point here is in the notes to the accounts, if you are giving whatever financial data is to be given, whatever financial or quantitative details are to be given, the corresponding figures have to be given. I've seen in certain cases for deferred tax, or when we say about my pending litigation, my fixed asset chart, specifically my property, plant and equipment chart, the previous year figures are not given. We are giving the opening and closing, but the aggregate of the previous year is not given. And when you will be seeing, maybe it could be covered into the commonly found errors in the FRRB, which Aniket Bhai would be taking thereafter. Because when it comes to FRRB, these points do come. It is an error. One has to comply with this, right? Then linking of notes with the balance sheet profit loss. You know, again, I'm just trying to bring out certain points where we have seen certain errors. And even in the case of listed companies, we have seen in the FRRB. So what is happening? You know, balance sheet profit loss we do, and then we forget to link it with the notes to the accounts. And specifically, the errors are in the previous year figures. So whatever is the figures in the balance sheet profit loss, if you check it with the previous year figures, they would not be matching in certain cases. So if those errors are there, in that case, kindly take care that the linking is there, right? Can the balance sheet profit loss be on the letterhead of the auditors? No, I know, yes. I totally agree. It cannot be on the letter of the auditors. It has to be on the plain paper or of the entity of the company. So what is the date of signing? here again, I'll want to know what is the date of signing, who signs first, what is the procedure for signing of an audit report or the financial statement by the auditors. So what is the process? Who signs first? Who signs second? What is the process? If anyone can write it down. Directors first, then auditor. Directors first. So when does the board approve? When does the board approve? After auditor signs, board approval, auditors has to sign after board approval. So director sign before the board approval or after the board approval? Nice. Director sign after board approval. When board approves, director sign. Yes, I'll just, all of you are nearly correct. The process is first the board approves, then the director sign, then it is given to the auditors, then auditors issue their report and they sign, and then the audited financial statements are given again to the board who calls the AG. Right? But how it happens in certain cases when my friends are going for the audit of the bank branches and they see the files of the companies who have been given the loan, that only the auditor's signature is there and there is no signature of the director. Everyone knows the process. Whatever I am talking today is all practical. Then how it is happening? How is that the auditor is signing first and not the directors? You must have also noticed several times that the client says, okay sir, पहले आप sign कर दो, मैं वापसी में director के sign कराते आऊँगा, दोबारा चक्कर नहीं लगेगा. Please don't do that, because in such cases, what does the management say? Okay, आप balance sheet लेके आ रहे हो, अच्छा एक copy bank में जमा कराते आना, because they are always in hurry. We have seen certain times, and this would be a clear negligence. Please understand and appreciate. You know, when I was doing an audit of one of the government agencies, and the secretary level person was the director. They said, okay, Pramod ji, you sign it first. The auditor would sign, and then, how he will sign later? So he is a secretary level, he is an IAS. So what? हम तो इससे पहले हमेशा ऐसे कराते आ रहे हैं. मैं कहा no, it is not done that way. First he will sign, then I will sign. So you have to put your foot down. And I am telling you this may be a small point which you are saying, which you may be thinking. But yes, in this thing, at several places we have seen that the auditor is held to be negligent. So one has to be very, very careful, right?
Yeah, Pramod bhai, you rightly observed. Actually, there is a disciplinary case where only one director signed. He said that my brother will sign later on, and he did not sign, and the auditor was held guilty by a disciplinary committee. So this is very pertinent point here.
So we all have to be very, very careful. Very rightly said by Chitley sir. So right, always take care for payment to shareholders for section 222E. You know, we are all the time getting confused, making the payment to the director or shareholder. वो पैसे दे देते, management makes the payment. And what happens sometimes, because the accounting is done in such a way that the loans are taken from the directors and then the payment is made, another account is opened. And when the financial statements are finalized, both the accounts go. And at the time of scrutiny case, what happens? Both the ledgers are being also sent to him. So he raises an issue of 222E. So I should be very careful. If all the related parties, there are more than one account, take care. And if it is payment made to the shareholders, section 222 is still applicable. So at the time of audit, kindly take care, because now this is reportable in 3CD also. Now, Certain issues I always try and discuss, even for the sole proprietorship firm or partnership firm financials. What I talk about my significant accounting policies and my accounting standards. Here I'd like to ask a question. In the case of proprietorship and partnership, do we prepare notes to the accounts? Do the management prepares the notes to the accounts? In the case of proprietorship and partnership, yes. So what do they write in the notes to the accounts? Just the issues like my inventory at cost or NRV, lower of cost or NRV, figures it at cost, income. So only these three, four accounting policies. Okay, my straightforward question on this: do we give the details of related party in the notes to accounts of proprietorship and partnership? No. So my next question, never seen. So my next question: are the accounting standards applicable to proprietorship partnerships? Yes. So when the related party disclosures are not made, so are you qualifying the audit report? No. So this is the beauty. We all know that for the proprietorship partnership, accounting standards are mandatory. We all know that the accounting standards are not being complied. And we still all are not qualifying the audit report. So who is to be held guilty, the auditor or not? And why we are doing it? Knowing that it is mandatory, knowing that they are not complying, we are still not qualifying. Why? In the case of related party transaction, someone says me in the case of proprietorship partnership, we give the details under 48(2)(b). No, it is not there. For the related party transactions, we have to give the names, we have to give the transactions not only of payments, but of the receipts, of the loans, of the purchase also, sale also, everything, and also the closing balances. Are we giving it the closing balances? Are we disclosing which is required under the companies, for the companies under the notes to account AS 18? Please see for the proprietorship partnerships also, all AS are mandatory except quite few, depending upon level 1, 2, and 3. Please prepare, if they are not complying, please qualify in your audit report. Because in such cases, only the auditor would be held negligent, not the management. In the case of companies, non-compliance of accounting standard, management is also responsible. In the case of proprietorship partnerships, where to qualify? Yes. So are we issuing any audit report in the case of proprietorship partnership? No. We all need to please reread our tax audit. Please reread your Form 3CB. We are giving our opinion of true and fair in Form 3CB, Para 3. No, sir, we are asking to disclose. No, sir, our audit report is there in Form 3CB, Para 3. Kindly read it. Our subject today is not tax audit, but when we are talking about financial statements, I tried and covered the proprietorship partnership also, because I know, because 3CB Para 3, you have to say that the financial statements, profit loss balance sheets are true and fair or not. And if not, they have to give the observations. So there you have to qualify. It is there in 3CB. Kindly re-see, please. And this is the reason. This is the reason when other professionals like cost accountant or company secretary say that we can do the tax audit, we have to make them understand it is not merely those 44 points of 3CD. It is the audit of the financial statements also. for which my accounting standards and standards of auditing understanding is required. So please, in the audit of financial statements, in Form 3CB, kindly see para 3. Sir, related party transactions are not disclosed in 3CD. They are only 48-2B. I've got a slide on related party transaction. I'll be discussing that too. Right? It is 48-2B. Under AS 18, it is totally different. In 3CD is only payments. Related party AS 18, disclosure is required for receipts, payments, closing balances. Everything is there. There is a huge difference between the two. Please understand, only a chartered accountant in practice can do the audit. And if he has to make his auditing skills, he has to improve his auditing skills. वो बात ये नहीं है कि बात ये है कि मैं ही ऑडिट कर सकता हूं, मेरे अलावा कोई नहीं कर सकता और मुझे ही नहीं पता ऑडिट कैसे करना. So we need to improve audit, right? चलिए. Now, balance sheet format, everyone knows. I'm not giving a time on it. Certain issues in share capital reserves which we might be missing. I'm talking about that. I have seen that the authorized paid up capital, the company has increased, when in my balance sheet it is not increased. Always check with the master data. Some of you might also have seen the authorized capital and paid up capital, if it was increased by a few lakhs, maybe 1 to 5 lakhs or 10 lakhs, it was submerged into somewhere advances and loans or something like that. So my balance sheet is wrong. So always have the master data downloaded from the MCA and verify. I've seen the errors. That I'm talking only about the errors. I've also seen in the financial statements, in the notes, the reconciliation of the number of shares are missing. It is missing. Kindly see that if there is any change in the current year or in the previous year, the reconciliation of number of shares is to be given, right? Also, the right preferences and restriction, this is also missing. What is happening in the notes when we are giving the detail of my only equity, share equity, we see authorized, subscribed, paid up, and that's all. This reconciliation is missing. This, even if there are single shares of equity, we have to say that the companies are only single shares and all have an equal right. This is required as per Schedule 3, please. Please see that. Of course, this question always comes to the mind that there is a loan and that is converted into shares. So in this case, whether we say it is a non-cash transaction, because we have to bifurcate my share capital, paid up capital into cash and non-cash. The answer, of course, is it is a cash. It is not a non-cash. Then also there is a problem in the reserves when we title one of the reserves as share premium. The terminology is not share premium, it is securities premium. So one has to take care of this. I'm just trying to bring out the some small errors which we are bringing into the Schedule 3. In respect of borrowings, when we talk about long-term and short-term, the first question which comes is, are the loan from directors long-term or short-term? Loan from directors are long-term or short-term? Short-term. एक विशाल जी का एक क्वेश्चन है. विशाल जी says, with due respect to all compliances, I would like to raise the issue of small CA firm wherein one is having fear of losing client. In such case, what approach is to be taken by small CA? The only approach you have to take is remove your fear. Believe, I'm saying it deliberately, please remove your fear. Let the client, if your service is worth it, client will never leave you. Learn to say no. Smaller clients, bigger clients, everyone is having a problem. If your service is good, he will be there. If you learn to say no, you will be doing wonderfully well. in just due to that fear of losing the client, we are sometimes compromising with the audit quality, which I request you not to do, please. Believe in yourself, the things are going to change. Nilesh Kulkarniji's question is there. Is there any compulsion in the audit even if the assessee is not eligible for tax audit? In some cases, bank have been asked audited financials to individual from borrowing from the bank. No, it is that not a tax audit, please. Tax audit, it would be there only if it is under section 44 AB of the Income Tax Act. Otherwise, it is just a feel-good factor audit. So I'm coming back to my question.
No, I think RBI has a mandated audit for big borrowers.
RBI has mandated the audit. Again, it is not a tax audit.
Yeah. No, it is not tax
under
audit, but true and fair view is required.
So it is
True and fair view considerations.
Under the instructions of the RBI. It is not under any law. So under an instruction, what happens? Let us take a case. There is a RWA. There is an RWA. There is a mandir. They say, okay, we have got certain activities audited. So that is also an audit. Right? Depends upon the terms and condition agreed. I am just talking, please, whenever I'm discussing, let us discuss all practical, no theory. Depends on term and condition agreed. Shekharji, when you are auditing the company's balance sheet, have you seen the terms and conditions? Vijayji, you have said repayable within 1 year. It is a short term. What you are disclosing in the financial statement? Director's loan, they are giving the loan, taking back the loan, a few lakh rupees coming in, coming out. And due to bankers or other situations, they say it is a long term. It is a non-current. So for a non-current, do you have that loan agreement? Because auditor is certifying it to be a current or non-current. So if it is repayable on demand, it is a current. So I have to, if there is no agreement, if it is current, there is no issue. There is, sir, cost. We should not think, Vishalji, from the point of view of bankers. Auditors should not see from the point of view of bankers. Quasi-equity is in their mind, bankers' mind. In the case of a company, there is nothing called as quasi-equity. It is purely a loan, and for that you have to file a DPT3. नीलेश कुलकर्णी जी उसकी बात करूंगा मैं अभी करता हूं उसके बाद. Now ROC forms are available for loans. What I'm trying to say that if in the financial statements loan from directors are stated to be non-current, kindly have that agreement in your hand which says that it is not repayable within the next 12 months. Without that, kindly never agree it to be a non-current. Ultimate, the responsibility would be on the auditor, that how did he visualize, how did he opine that it is a non-current, right? From, of course, CC limit demand loans, yes, we have just now discussed, it would be always current because they are repayable on demand, so they are current. Now, in this, when we see the secured and unsecured loans, we talk about security. So, if the security, sometimes we miss to say it, if it is guaranteed by directors, then we have to show it separately. Now, here also one question which I always ask. The company has got a loan from the bankers on the guarantee of the property of the director. The loan has been given against the property of the director. So whether it is a secured loan or unsecured. Sandeep ji, mere MRL will not suffice. Secured. Shekhar ji saying secured. Secured. Ulas ji. My question, Kishore ji saying unsecured. Rest all are saying secured. I am just repeating the question. Company has taken a loan against which the director's property has been given again. So it is a loan against the property. So everyone is saying secured. Avanti ji is very rightly saying it is unsecured for the company. Ravinder ji, Ruchita ji. So it is unsecured loan. It is not a secured loan. From the banker's point of view, it is secured. But from the company's point of view, it is unsecured. Please, right? Chitteja ji and others are saying yes. So please take care. It is an unsecured loan, not a secured loan, right? For security, the property of the company has to be there, right? In the terms of repayment of term loans, in the case of term loans, we have to also give the terms of the repayment, which I have seen missing in umpteen number of balance sheets. The terms have to be given. What is the period of maturity? What is the number of installment, amount due of installment, applicable rate of interest? So these all have to be given. Also, the period and amount of default in payment of principal and interest as on the balance sheet date. So if it is made good by 31st March, then nothing to be done. Otherwise, you have to do it. For the other current liabilities, the current amount of maturity of long-term debts and all others are there. I'm not going into this detail. Everyone knows about it. So other current liabilities, we also got other payables, and other payables would be including statutory dues and other payables. So classification of an item payable or receivable is very important. Fine. So liabilities, certain issues I'd like to discuss. You know, in my what I've been deliberating on this subject since past few years, in the last one or 2 years, I had stopped mentioning this item because I felt that now no company is disclosing any share application money pending allotment. Because if you are disclosing this and it is outstanding for more than 60 days, then it becomes a deposit. So I was of the view, because if the share money, application money pending allotment was pending prior to 1st April 2014, so I suppose 1st May 2015 was the last date to have disclosed it as a share application money. Beyond that, it became a deposit, and by this time it has to be settled. But recently, in few of my deliberations, within past few months, one of the members said, okay, my client is still disclosing share application money pending allotment. I asked, since how many years? This is more than 6-7 years. So this is not allowed, please. Neither, it would be a problem for the management because it has become deposit and he is not reporting in the CARO. The auditor is not reporting in the CARO. So it would be a problem for the management as well as the auditor. So please don't allow these things. The responsibilities of the auditors out there, right? Loan from friends. Though it has been, you have also discussed about deposit in the last 2 days. But I have been receiving questions that I have received loans from the friends, directors' friends, shareholders' friends. Not allowed, please. Not allowed. You have discussed in the past 2 days session from whom you can take a loan and deposit. So I'm not discussing in detail, but yes, it is not allowed. It is a clear-cut violation of section 73 to 76. Current, non-current loans, I have discussed, giving the example of directors, right? So have an agreement, please. Advances from customers. Now, again here, I'd like to mention the role of the auditors is very, very important. Because of this, which we have been allowing them, the form DPT3 has come. Because you see, your client, suppose he is into trading of footwear and he is taking an advance from customer from a real estate builder. What he is to supply to him? What is the advance? And if it is few years old, few months, more than a year old, so I received a question saying it is 4 or 5 years old, and you ask the management, they don't even know from whom it has come. So what is the role of the auditor? Have you agreed that it is advance from customer? What he has asked, why he is not supplying? Has the auditor asked about it? How did we allow him to disclose it as an advance from customers? I have to be very careful. Please, auditors, risk is purely out here. Please take care. It has come into the, it was already there, always an issue, and it has come to the eyes of all the stakeholders. So please beware, and we need not worry. I've always been saying the auditors have to state whatever is there in fact. Whatever is the fact, they have to report that in the auditor's report. They need not worry at all. If the management is not worried, why is the auditor worried to say? Can he say whatever he is saying in his MRL? MRL is just one document. You cannot base every of your audit report on based on the MRL. Your further audit documentation is also required. Right? Trade payables aging. You know, this I have been talking since past few years now. We are asking for the aging of the debtors. Are we asking for the aging of the trade payables? पूछ के देखिएगा. Ask. More than 1 year old, more than 2 year old, more than 3 year old. Why it is not being paid? Please ask for the aging. Everything will come to your knowledge. What is happening? What is not happening? Because if they are actually not payable, you have to write it off in the profit loss. Right? So, any questions on this liabilities issues? Then we'll go to the asset side. For filing ITR, aging of creditors is required. So it is obtained in the course of, I don't know if it is good. I have never looked into that. The aging of creditors is recorded in the ITR. I have not seen, maybe. A lot of companies write back trade payables which are appearing as outstanding for more than 3 years. Sandeepji, I agree that they are writing it off, but first of all, the auditor duty is there. Na? The trade papers we are talking about, so aging do we have? It is not about 3 years, the Limitation Act, Section 41, all those things under income tax is there. But as an auditor, we need to ask, do we do external confirmation of thereof or not? So I have to be very careful. 12 EMIs due out of 10 years long term for payment from the date of balance sheet, whether current or non-current. In the case of term loan, when it is the remaining 12 EMIs payable in the next year is current maturity of long term. Current maturity of long term, it is disclosed. I've just disclosed it is not short term, but it is my current liability. What about Amolji's question is, what about pending creditor not paid? Now we have booked income. What about MAT? Just pay the tax. It is not about MAT. It is actually the tax which is payable on that. It is cessation of liability under income tax section 41. So you have to pay tax on that. Not only MAT, normal income tax is also paid. Right. Chali. Now going to the asset side. Asset side, let just few things I'd like to discuss about here is when we say on the face of the balance sheet, the property, plant and equipment, it is to be classified as tangible asset, intangible asset. Are we anywhere classifying the intangible assets? Apni company se case mein, are we classifying it? Just take care. Softwares are intangible. If not, disclose that as intangible. That does not become tangible. Capital work in progress and intangible assets under development. These are to be shown on the face of the balance sheet. Now, a question out here again. The company is to purchase a plant machinery. The company is to purchase a plant machinery of 10 lakhs and it has given an advance of 1 lakh. Right? And that machinery is received on April 2020. Say June 2020. We are talking in the current scenario. So it is received in June 2020. So now this advance I have given to the plant machinery, where to disclose it? Would it be short-term, long-term, capital work in progress? Where to disclose this? As on March 20. Capital WIP. Ravindra Joshi ji is saying capital WIP. Any other view? Capital WIP, Shutija is saying, Niranjan is saying long term as capital advances, short term loans and advances, capital WIP, advance against capital. Sir, Avanti ji, notes to accounts की बात नहीं है, disclosure in the financial statement which had. In this case, advance for purchase of asset, no, we have to first classify into current or non-current, right? So we have to see whether this, because within 12 months, it is already receiving. So whether it is short term or long term. So it is not to be grouped as capital WIP. No. It is always a long term loans and advances. Why? Because on the conversion, it still becomes a long term. And this, what I'm stating, is everything given in our guidance note. I'm reading, what I'm discussing today is all schedule 3 itself, plus the guidance note, combining both and the practical experiences, right? So please, it is not capital WIP. Prior to 2012, it was under capital WIP. After 2012, when the Schedule 6 was amended under the 1956 Act, it is to be disclosed or classified. It's to be classified as long-term loans and advances, please. Nowhere else, right? Inventories, certain issues that the classification has to be there. Like this. Raw materials, work in progress, finished goods. Stock in trade is for trading goods. I've seen in few listed companies also that they are disclosing the even trading goods as finished goods, which is wrong. It has to be stock in trade. There is a difference between finished goods and stock in trade. Now, one question again I'm asking out here, that in the case of, again, I come back again and again to proprietorship partnerships. In the case of proprietorship partnership, in the case of inventory, do we classify or just write inventories as certified by the management? In the case of proprietorship partnership LLPs, do we classify the inventory or not? Or just give the do not classify? In our template, I'm not classify. I'm talking about a proprietorship partnership. If we are mostly as certified by the management, we are just giving closing stock or inventories, but not classifying. Please note that this. But please note that this is mandatorily required to be classified under these items, even in the proprietorship and partnership, please, or LLP. Why? It is required as per AS2, as per ICDS 2. Required mandatory classification, please. So if AS again is not complied with, issue the qualification, right? Finished goods, they should include all goods except acquired for trading purposes, of course. And stock in transit has to be disclosed under the relevant subhead, whether it is raw material or finished goods, or raw material or stock in trade, of course, or store space, whatever it may be. Certain questions on the assets always, do we understand what is an investment property? Do we understand what is an investment property? In the case of non-Ind AS, I'm talking about. Rahulji, we are not classifying that. That's why I'm discussing. Start classifying. It is required under AS2 and ICDS2 both. Not used in the business of the company, Deepak ji is saying. So are we classifying any fixed asset which is given on hire or rent as investment, or we are showing all immovable properties under fixed assets only? Are we disclosing it as an investment? Yes, are we disclosing? But showing under figure sets, no. Rahulji, not required. Investment properties are not, Sandeepji, the thing is, first you have to identify that immovable property is an investment property or not. Investment property would be the property which is kept for the purpose of appreciation or for the purpose of letting. It is an investment. It is not used in the business, what has been discussed, right? Said also, right? So these are not my property, plant and equipment. It has to be under investments. So if we are not doing it, please start doing it. Please start doing it, right? Inventories, please take care. In inventories, what I'm trying to say, that your company's turnover is say 10 crores. Your production cycle to manufacture a product is 2 to 3 days. And your inventory is 4 crores, 5 crores, 6 crores. Why? Does the company has enough godown to store the stock? Does it have so much of insurance? Every year, why the inventory is going high and high? The moment it becomes NPA, inventories become zero. Please, as an auditor, take care of the inventories in the finalization. My account auditing standards and all things are required, but we need that knack of analyzing the financial statements, and we know our clients. Both things are there. Please take care. The inventories are rising year to year. The ratio to my turnover, why it is so required. Please take care of this. Cash in hand, again, you need to document each and everything. If it is high, why it is high? Because if the client is having any problem, the issue would be on the auditor. Please. The cash in hand is 50 lakhs. It is not into retail business. It is into manufacturing. Why is cash so high even though he has taken loans from the bankers and others? Why having so much cash, he is still withdrawing 25,000, 50,000, 1 lakh rupees? So what questions you have asked? What is your documentation about it? And always, please don't say what should be the answer. Ask the question to the management. Don't step into the shoes, don't get into the shoes of the management. We may be supporting, we may be assisting the management, I'm not saying about it, but being an auditor, remain as an auditor. Document your all findings, why it is so. The answer may have to be given to so many stakeholders, right? Loans without interest, not allowed as an asset. From directors, it can be taken. From relative of directors, it can be taken. But the giving not allowed even to the subsidiary. It is a non-compliance of section 186 subsection 4. And you have to report in Caro. You have already done Caro yesterday or maybe day before yesterday. So take care. Loan cannot be given without interest free. Debtors aging provisioning. Again, here what I want to say, that aging we are doing 6 months and other than 6 months. The debtors are pending since more than 1 year or 2 years. And still we are not making any provisioning, which is required as per AS4. You have to bring it to the current value now. I have seen many cases where there are litigation and still no provisioning. Everything is good. How it can be good? When there is a litigation, straightforward, everything is good, and one day it becomes bad, directly bad. No provision made for doubtful debts. In umpteen number of balance sheets, you will be seeing it. Kindly, if it is not being received, the client is saying that there is a problem, he is not paying, either he has gone for the IBC, insolvency and bankruptcy code. If he is not going, then why the provision is not being made? The role of the auditor comes out here, right? And in the times of COVID also, again, you have to be very careful. The provisioning would be required. Not only COVID, every year you have to be very careful, right? So take care of this. This item should not be there in the balance sheet. Still I see maybe less than 2% or 3% maybe. Percentage I have given out of my own just will. There is no percentage. That a company is incorporated, the preliminary expenses, they are to be written off in 5 years under Section 35D of Income Tax Act. So write off 1/5 every year, which is wrong. After AS 26, write off in the first year of the incorporation itself. Please take care of this. It cannot be recognized as per AS 26. Any question on the asset side? Then we'll go further. Purchase of a land in the name of director, like agricultural land for the purpose of setting of factory. What should be reporting? Clear cut, all the assets should be in the name of the company. Further, there is a requirement under the auditor's report where any asset which is not held in the name of the company, that has to be disclosed and the reason. When the software is embedded into that hardware, Sandeep ji, when the the question is about the classification of the firewall and the hardware, when it is embedded into that hardware to make it run, then we did not classify. But when we are purchasing a software separately, kindly do classify for the intangible assets. Right? चलिए आगे चलिए. When we talk about revenue from operations, yes, for companies other than finance, it has to be like sale of products, sale of services. For finance companies, revenue from operations would be interest in other services, and the revenues to be recognized as per AS 97 for service construction contracts, that is on percentage of completion contract method. So I have to be careful. I'm not discussing this in detail, but yes, just mentioning the AS as per the service contract is to be recognized, where we are doing certain errors. So kindly take care of that. Other income to be classified like this. What we are missing is, if the interest and dividend is there, then we have to disclose separately for current as well as non-current. We are just disclosing interest and dividend and not disclosing the current se kitna hai, non-current se kitna hai. This is again the requirement of Schedule 3. Kindly see and correct wherever it is not done. Expenses, disclosure on the face of the profit loss, cost of material consumed, and purchase of stock in trade. Here I have seen that even in the case of listed entities, cost of material consumed is only for manufacturing. Purchase of stock in trade is for trading. Once this is itemized into my profit loss, then year to year it is going on, even though I stopped doing this. It is still shown under this. So I have to be very careful. Further, the disclosures are changes in the inventory of the finished goods, employee benefit, finance cost, depreciation, amortizing expenses, and other expenses. As regarding finance costs, of course, these loan processing charges, all these are finance costs. The question which comes is interest on tax. So I'm paying interest on tax. which is say 234AB or GST interest or something, whether that is an interest cost or a finance cost. Where to disclose that? Interest on tax. Other expenses from the GI. Not a finance cost. PL appropriation में Kshitija ji, nothing goes. PL appropriation is purely, even the income tax goes to PL now. There is nothing appropriation. PL appropriation is directly into now my balance sheet, reserve surplus. Interest on tax is a finance cost. Interest on tax is a finance cost, please. Please take care. It is not other expense. It is not interest cost. It is a finance. It is the interest cost. It is a finance cost, right? So interest on tax is a finance cost. Please take care. Other expenses. What is happening that these expenses cannot be clubbed. What is seen is that these expenses are clubbed and shown as repair and maintenance. Not allowed. Why I'm telling you, and I have seen the queries raised by the MCA, by the registrar of companies, wherever the investigation is going on, and they say, okay, this is not done, Schedule 3 is not complied, go for compounding. These expenses, howsoever minor, cannot be grouped. These all are to be separately disclosed. Other expenses, take care, right? Others, we all know, expenditure which exceed 1% of the revenue from the operation, whichever is higher. Coming straight forward to the notes to the accounts now. Any question? I'll take the questions at the end because we have got hardly 15 odd minutes. Then Aniket Bhai would also be there. Accounting standards, if I talk about, I always ask a few questions on these accounting standards. Today, due to paucity of time, I will not be asking. I'm just trying to inform you that everyone is to follow the accounting standards, and companies have to follow. Other than companies have to follow, companies have to follow either the company's accounting standard rule 2006 or the Ind AS ICTs. Everyone has to follow. Other than companies have to follow accounting standard issued by ICAI. Proprietorship partnership, they have to follow this, and the ICTs as per the Income Tax Act, right? So AS disclosure it notes, one of the most important AS which I feel is, one thing is more important prior to that, is SMC or non-SMC. If my company is SMC, as per the Schedule 3, as per the accounting standard, the company's accounting standard rule 2006, general instructions, if it is an SMC, which many of our clients are, in that case, we are allowed to take certain reprieve. We are allowed certain concessions from the disclosures. No concession is there in the recognition, but there are concessions in the disclosures related to my AS 20, AS 15, AS 29, so many. So if I'm taking any one, I have to take all. And there is a paragraph which is to be stated in my notes that my company is an SMC and I'm availing of these disclosures. And what is given in the instructions, general instructions, the preface, it is said that if you are an SMC, please write this paragraph in your notes to the accounts. They have mentioned that paragraph. They have given the wordings. If we are not doing, please start doing it, right? And then of course, AS1 is one of the very, very important accounting standard, because this standard says that all the significant accounting policies have to be disclosed at one place, which we call as significant accounting policies. And I've seen that once these are prepared, they are never changed. Normally not changed in the SMC companies. And in certain cases, we are not even disclosing the policy. kindly see, we might not be disclosing the policy for borrowing cost, AS 16. कर रहे हैं क्या? आप कहोगे हमारे तो borrowing है ही नहीं. Borrowing could be from director, director's relative, bankers, it could be from anyone. And you don't know, sometimes you take the money, repay back. Disclosure is required, the accounting policy is required. It also says how much you have capitalized. So you have to mention. So all accounting policies are one place that is required. Financial statements, they have to be prepared in compliance with the accounting standard, and it has been given in the Companies Act that it has to be compliant. If not, then the financial statement has to disclose, the financial statement has to disclose the deviation. Reason for the deviation and the financial effect is required in the financial statements, please. Also, non-compliance of AS 15, my actuarial valuation, or any other my segment reporting, it is on non-SMC, but all other standards. If there is a deviation from the accounting standard, the disclosure has to be made, reason in the financial statement, and if it is not done, the management is to also be reprimanded, along with the auditor who is issuing his audit report, stating that the financial statements are in compliance with the accounting standards. Right? This is just a chart. This is just a chart about the AS applicability upon the companies and other than companies. These are for ICI's accounting standards, level 1, 2, 3, non-SMC and SMC. Right? Depreciation has been omitted. I'm not going into detail of this. Now comes about the related party, which was saying. You know, when we talk about related party, it is defined at 3 places. One is my accounting standards, for which the relevant standard is AS 18. Second is my Companies Act, wherein the related parties are defined into section 2, subsection 76, and the transactions which are to be reported upon thereon is section 184 and section 188. And third is my income tax, and for which the definition is given in section 48. All the 3 are related party, but all are different. Every regulatory requirement is different, please. When I talked about proprietorship partnership, some of us said we are disclosing in 3CD, that is only 48(2)(b. Here only payments are required. Some of the members, some of the persons may be same, but some of the members could be different in the definition. When we are talking about AS 18, it is in the notes. The disclosure, and for this definition, as per this only is to go, not as per this or this. I've seen I've been fortunate to be a part of the Tax Audit Quality Review Board also. And what I had seen, that in the 3CD of a listed company, of course, the related party were given as per AS 18. It cannot be. In 3CD, it has to be this only. In notes to the account, it has to be AS 18 only. Here only payments is to be given. Here payments, receipts, income, expenditure, commission, loan given, taken, capital, everything is to be given along with the closing balances of the parties. When we are talking about Companies Act, then the relatives are defined here, section 2, section 76. And related party, the restrictions are there with treating with them, not as per this or this, only as per 276. Or where my transaction is under section 184, subsection 2, and I am having more than 2% into those related parties, then a resolution is to be passed. So for these purposes, this definition. For this, only this, AS 18. I cannot interchange the definition for the related party. And yes, this related party transaction is most important to understand that entity, that how much the entity is dealing with through its related party. Right? Certain other important items and notes which we should take care is of contingent liabilities and commitments. This I have seen missing in many of the financial statements. We all know that earlier quantitative details were required. But now quantitative details is not required. But in the broad heads, my raw material, my income, my purchases, what is the nature and the amount? I have to give the value of the major items. Kindly see, this is required. Fine. Then of course, value of the imports on the CIF basis, this detail is required, and expenses in the foreign currency on the accrual basis, and dividend on the cash basis to the foreign company in foreign currency, what we have given, and foreign exchange earning on the accrual basis you have to give. I'm just speeding that up in that basis. Other disclosures, are we giving this disclosure in the financial statements related to loan given, investment made, guarantee given, or security provided, along with the purpose of loan for which purpose of loan or guarantee or security, which is proposed to be utilized by the recipient of the loan or guarantee or security. This is the requirement of section 186 subsection 4. You know why I am telling this? Because once the notices are being issued by the registrar, they are finding out these finer points where we are making errors. They are taking out these finer points. Please see that even the proposed to be utilized, the purpose is required to be disclosed in the notes to the financial statements. I have to be very clear and mention in my note to accounts if I'm not doing it. And the contribution to the National Defense Fund, that is to be disclosed in the notes. In the public companies, another disclosure which is required is money received from the director. And in the case of private companies, I have to again disclose money received from the director or money received from the director relatives. This is as per the, we have just gone through the deposits last year. So, last day or last to last day. So this is requirement as per the company's acceptance of deposit rules 2014. This is the requirement as per that. This is what happens because the time for the audit is always less. I'm not talking about account auditing standards, but yes, just to tell you that total 38 standards on auditing are there and majority is on audit evidence. So please take care of this. I'm going straight forward about the audit reports. Of course, under the Companies Act, as per the CARO or the IFC, it is required. It could be a non-CARO and it could be a non-IFC. So accordingly, it would be different. And other acts, tax audit, it could be either 3CA or 3CB. And for LLP, okay, one question I'll take. So that would be covering my concept on the audit report. Simple question. There is LLP which is required to get its tax audit done. Namaskar, Aniket bhai. Right. So my question there is, so there is an LLP which is required to get its tax audit done. Which form is to be issued? Form 3CA or 3CB? Three CA. Everyone is saying 3CA. Why? Why? Because LLP, there is a requirement to get its account audited under the LLP Act. Is this right? Very rightly, Vijay Bhai has said 3CB. LLP 40 lakhs turnover. So under the LLP Act, the audit is required. So LLP Act, right? Now, if under the LLP Act, the audit is required, my question is, what is the audit report format for the LLP Act? Sir, वो income tax का है. I am talking about audit report under LLP Act का format क्या होगा? Audit report under LLP Act. Last week. Not specified. So you will not issue the audit report, Deepakji? You know, only a chartered accountant in practice can do the audit. He has to issue the report. He should know na. Form number 6. Ulaji, I have not heard about it. Generic for non-corporate format, Deepak ji कह रहे हैं. So we राहुल जी का कहना है we will issue audit report as per Companies Act. Sir, Companies Act का provision बताएं जहाँ audit report है. Standard audit report. Yes, Dolly ji or Sandeep ji are very right in that way. When we talk about audit, you need not look anywhere else. You have to look only at the standards of auditing. So SA 700, SA 700, and if required 705, 706. For the clean, unmodified report, it is SA 700. So where to look for the format is purely SA 700, nothing else. Never to worry, even if it is a Pune branch audit, where to look for the format, SA 700, right? Chali, great. So my company's audit report, I'm not going into this now. Everyone knows it. IFC applicability, you all know. I'll just take, because Aniket Bhai is there, I'll not talk about Caro 16. You have discussed in the
Sir,
past.
take your time, sir.
No, Aniket Bhai, I know. That is so generous of you, so nice of you. Caro 16 में मैं सिर्फ आपने, you have already done it yesterday or day before yesterday. So my only one question on the applicability. There is an ABC Private Limited. Its authorized capital is 5 crores. Paid up capital is 50 lakhs. Reserve and surplus is 90 lakhs. Total makes 1.40 crores. Turnover is 1.75 crores. Borrowings are 2 crores. Caro applicable or not? Caro applicable or not? You have gone through the Caro 2016 yesterday or day before yesterday. So my only question, whether in this case Caro would be applicable or not. Applicable. Shareholder fund exceed 1 crore. Yes, Kshitija ji also says, everyone says yes. Ruchita ji also is saying. Smita ji is saying yes. So everyone is saying yes. Bhushan ji is also saying yes. So everyone has gone through that Caro 2016 very well, right? So my answer is no. Why no? You know, we straightforward jumped to that private companies 3 conditions. Is a Caro applicable to OPC, small company? Is this not a small company? My paid up capital is 50 lakhs. My turnover is less than 2 crores. To a small company, Caro is applicable or not? Right? So getting it? Good. So I just need not jump into that 3 things. I have to be very careful on this issue. Uh, Audit report, I'm not discussing this because we all know that SA 700 when we were talking about this. So when we are talking about the private companies, this is the format. For LLP, this would be a format. This read with this, right? COVID-19 impact, I have to be very careful about a going concern. And when I joined, there was a question about do we have to consider the going concern even of a small CA firm? If we are auditing it, yes, you have to see even the SA 570 is applicable even to a small CA firm. If it is being audited, we have to see it. Inventories, I have to take care. Ratio comparison, take care, because most of the clients are doing the ratios as per comparing their profits, the GP ratios, and then decide their calculations. Please, in the COVID times, if the profits are down, let it remain down, right? Take care. MSME compliance, everyone has to do, make the payment within 45 days. COVID or no COVID, there is no relaxation given, please. Notes, please take care what is to be given. And because there is no change in either accounting standards or standards on auditing, no change, please, due to COVID. So one has to be very careful. Other important points I always wanted to say, a question has always been raised about whether we can issue projected balance sheet and provisional balance sheet, and you did there. You know, please take care that we should normally not do it, but if we have to do a projected balance sheet, then use the reporting of SAE 3400. I started my whole deliberation upon taking care of our reports, what we are issuing, what is our final product. So please don't write whatever you want. Institute has done tremendous work in the last 70 years. Please use these reporting. We have to use this only. And if I talk about my provisional balance sheet compilation agreement, at least the auditor of that entity cannot do it. He cannot do it because if he compile, then he is disqualified. But if you are doing of any other entity, please use the reporting format of SRS 4410. Don't just say compiled and issue a certificate. Our stamp and signatures are very important. Just don't put it anywhere. Wherever you have to put, it has to be along with a report, even if that format is of someone else. And mine institute standards are not only standards on auditing. They are SREs, SAEs, and SRS only. They are 2 to 3 only maximum. Just at least if you don't read it, read the title. It might come to your rescue at some point of time, right? And of course, any certificate you have to issue, please refer to the guidance note on reports or certificate for special purpose. You should issue any certificate, even it is for net worth or directors list or shareholders list. Use this format. Only this format, nothing else. Even if suppose a tender or someone says this is our format, you write it, it is to be read along with our report and issue the report accordingly. And when you are issuing such certificate or report, always generate UDIN. Always generate UDIN, right? So guys, this is just I'm closing. This is my last slide. You'll be wondering that I'm talking about audit procedure in one slide, plus just summarizing it, friends. Of course, get an appointment letter, get appointed, have an appointment letter. After the appointment letter, have your KYC of that entity, have that engagement letter. Without engagement letter, don't commence any engagement, whether even it is a branch audit or tender audit or whatever it may be. Even internal audit, whatever it may be. Please obtain engagement letter, because that could come to our rescue at many times. And of course, understanding of the client, what does it do, how it is do, what software they are using, what are their DRPs and VCPs and what are their accounting systems, what are their purchase systems, sales systems, realization systems, understand the client, what are the regulations applicable to it, and then of course plan. Planning is important. Specifically, there are so many things I'm just saying, including materiality. What is the materiality limits? What the risk assessment? These are very, very important. And then of course execute with your audit programs, checklist, your standards on auditing, and then have the representations, the required certificates, the management representation. If you just read the audit report which you are issuing, on every point, you see what is your documentation and what are the MRs and certificates. Just read the audit report, you will get to that. And then of course, reporting with the UDIN. Reporting with the UDIN is required. So this would be the audit procedure. Anything else left in this audit procedure which anyone can add? The audit is complete, right? Here, one step is left, which is billing and collection. You know, I always emphasize on this. If you are not doing the billing and collection properly, the whole system is going wayward. We are afraid of charging and asking for the money. Please charge appropriately, ask for the collection in time. Always that person is valued who charge. That person who doesn't charge or charge very less is never valued. You always talk about that advocate or that professional who charged 10,000 per hour or 1 lakh rupees per hour or 5 lakh rupees per hour. You don't talk about that person positively who's charging 500,000 rupees for a return. So please charge appropriately and make the collections, right? And of course, audit not documented is audit not done. You are doing so, we are all doing wonderful work, but not creating the documentation. Let us do something for ourselves and create that documentation and have that faith of all the stakeholders, right? And always increase your value. I say increase your value just by saying that you can have a cup of tea at footpath, or you can have a cup of tea in a normal tea stall, you can have a cup of tea in Cafe Coffee Day or even a 5-star. You always talk about 5-star. So it is valued by how much you charge. So what you deserve, please charge appropriately. Please charge appropriately. Think about yourself, right? And this presentation I'll be sharing with the Pune branch as well as uploading here also. And anyone can, many of you are using out here this portal, expert panel. It is experts panel, anyone can register, sign and register and ask free questions on various subjects. Many experts are there throughout the country who are answering. More than 100 experts, they've answered more than 20,300 answers already there in the last less than 2 years, right? Thank you very much. I've taken another 10 odd minutes of Aniket Bhai. So sorry, Aniket Bhai. So sorry, Aniket Bhai. Thank you. Thank you everyone for the very nice time. Thank you.
Shikhar sir, please give closing remarks.
Sorry?
Closing remarks.
No, let Aniket start. It doesn't require any opening remarks.
Yes.
Now, Pramod has very wonderfully concluded the topic allotted to him. And I'm sure that the extension of, if you don't follow what Pramod has said, I think Aniket will take care of it in FRRB. That would be the thing.
I would like to thank CA
FRRB is the board. Basically, it is taking care of public companies. And then if they are erring in compliance with accounting standards, auditing standards, maybe there are a number of agencies like CPE and other agencies, NAFRA now, they may be making reference to FRRB. On their own also, they select companies for the purpose of review. and wherever non-compliances are observed, various steps, including disciplinary case, are initiated by FRRB. This is not to frighten the chartered accountants, but then upholding quality is of utmost importance, because Pramod said that, okay, we have to value ourselves as a 5-star, but not by giving third-class services. If you want to charge 5-star, you have to give 5-star services. And the equipment for equipping ourselves for giving those 5-star services is arranging lectures of Pramod Jain and Aniket Talati. Definitely, we will be in a position to do that. And Pune branch has definitely earned accolades for arranging various value addition programs. It is not just CPE hours, but they are also much enriched as far as this knowledge level is concerned. So I thank you, Pramodji, for being with us. And as I said earlier, both of you, Pramod and Aniket, sometime you can visit Pune once this pandemic recedes. With that, welcome, Aniket, and over to you, Kashinath.
Good afternoon. I would like to thank CA Pramod Jain sir for his wonderful insights in corporate law. I am also grateful to him for his giving valuable time for in spite of his busy schedule. Thank you, sir. Thanks all participants for patience with me. Now over to Abhishek.
Yes, thank you, Kashinath. Thank you, Pramod sir. It was wonderful. I think so. It was one of the two-way session. You were continuously asking and keeping all the members handy with their keyboards and as well as their minds also. Sir, may I request you to please answer the queries in the Q&A column of the. Can you see that, sir? Yeah. So all the members can. Yeah.
अनिकेत जी का टाइम चला जाएगा सर, मैं आंसर दूं.
नहीं सर.
नहीं चैट
you may
चैट
please
बॉक्स
type.
में करो और प्रमोद
अच्छा,
को
चैट बॉक्स में आएगा आंसर. ओके
Yeah.
ओके.
हाँ,
जितने
भी आपके ऐसे क्वेरीज रहेंगे ना, उसका एक पब्लिकेशन निकालो तो सबको सब मालूम हो जाएगा.
नहीं, ठीक है. सॉरी ठीक है.
Yes. Thank you so much, sir. We have another dynamic CCM over here. I hand over the session to Amruta.
Thank you, Abhishek. Welcome, Aniket ji, and thank you so much, Pramod ji, for the wonderful interactive session. Chitley sir has very well mentioned the word of caution in the closing remarks for the previous session, which has really set up the tone for upcoming session. And may I now request CA Aniket Talati, who is the chairman of FRRB at the ICAI. He is a man of refined thought process and quick understanding, and also a sharp vision. He is a Central Council member for the term 2019-22. He has served the profession for about a decade. He has served as the youngest chairman of the Ahmedabad branch for the year 2014-15. He is a regular speaker at various conferences and seminars, and he has published numerous articles in newspapers, magazines, and professional newsletters. So may I please request Aniket ji to share your views and also focus on some of the common issues which are observed or identified by the Financial Reporting Review Board, because Chitley sir has rightly mentioned in the closing remarks for the previous session that it's indeed a moment of caution for all of us to take utmost precautions. So we would like to hear insights from you. Over to you, Aniket ji. The stage is all yours. Welcome.
Thank you so much, Amruta ji. My respected two council colleagues, Pramod ji was the previous speaker. I think you've all been benefited by his immense knowledge. It's somebody that we look up to. In fact, the new website of the ICI was done under his convenership. We are seeing all these CSR activities again under his leadership. Valuation is what he's the chairman of. And more importantly, I think when he talks and speaks to members, touches the most relevant aspects that affect our day-to-day practice. It may be the smallest of small things of when he mentioned about certificates. And then there is a guidance note of the institute, which is very specific and clear. I don't know how many of you noted it, but please go back to his presentation and refer to that guidance note. One of the finest pieces of documentation of how you must issue a certificate. It is not that someone just comes and says, net worth certificate chahiye, and we issue a net worth certificate. There are steps, starts with the engagement letter and very rightly mentioned, goes up to the collection of fees, which is very well detailed and mentioned in that guidance note. The certification of prospective financial information, whether you can do it, you have to look at the schedule of the Chartered Accountants Act, clause 3 of the second schedule, which says I cannot certify any future information saying it will be true because as of today, astrology or astronomy is not a part of the CA course. So you cannot say what is going to be true in the future. But yes, you can verify the assumptions and the calculation as per SAE 3400. So I think very good parts that were covered, Pramodji, by you. One of my favorite topics to also talk upon, and compliment, sir. It was always a pleasure to hear you.
Thank you, Aniket. So nice.
Thank you, sir. And our senior colleague, Chitley, sir, who is this year leading the charge as the corporate law committee, the entire CGCLC, which is one of the most important committees, I can say, within the institute. The IBC was born out of the CGCLC. Even today, the entire work of dealing with the MCA, giving out all these guidances, communicating with them, and especially today when we have seen the NFRA has, I don't know how many of you could go through it, but has issued the first penalty order today, barring one of our chartered accountant members for a period of 7 years. He will not be able to do audit of a company or any body corporate. And that order has been issued only today. And that is where, the change in our profession is coming. We all have to appreciate and accept that that is going to be the future. There is additional regulation. The level of expectation of all regulators from us as chartered accountants has increased tremendously, especially in the corporate domain. And I think the role of CGCLC is in that way is extremely far widened, and we are all fortunate that we have somebody like CV Chitley sir chairing the committee. It's always a pleasure to work with him, and thank you very much, Chitley sir, for inviting me today here and giving me this opportunity. Like sir has mentioned, yes, FRRB, it is one of the committees. Somewhere it gets misinterpreted as the committee which danda leke sabko marti hai, but in fact that is not the role. So I would like to, before we go to the topic proper of the observations that the FRRB has taken up and what are the non-compliances that we've noticed, I would also like to take you very briefly through what are the activities of the board so that you can appreciate, the whole perspective in a wider manner. So yes, I hope the PPT is visible to all of you. The Council of the ICI constituted the FRRB way back in the year 2002. So this is not something which is started now. It has been there in prevalence for 18 years now. And the FRRB has been continuing to do its function. What is the role or the scope of FRRB? Some of you who may be young chartered accountants might not be aware. Also, because of our interaction with the institute, somewhere gets restricted only with relation to our fees, our CPE, registration of articles, but we are not so well versed with the functioning of all the committees of the ICI. That is why I wanted to, acknowledge what the CGCLC under chairmanship of Chitley ji is doing, or what Valuation Board and CS are doing with Pramod Bhai's leadership. Similarly, I have been this year given the charge of chairman of FRRB, and the FRRB's number one scope is to review general purpose financial statements of enterprises, which are selected either suo moto or special case. So what are general purpose financial statements at the first? Very important for us to understand, because sometimes what happens is हम सब चीज को audit बोल देते हैं. Attestation किया, certificate दिया, assurance किया या audit दिया. These all have different meaning. Audit is not the same as assurance. Assurance is not the same as attestation. They all have different meanings. What is that? Audit is a limited part of issuing an opinion, which is the highest form of opinion. As a chartered accountant, मैं opinion अलग-अलग form में दे सकता हूँ. I can give a review, which is, you will have seen the case of listed companies on a quarterly basis. There is an unaudited result gets published. Unaudited क्यों है? क्योंकि audit नहीं हुआ. But there is a limited review certificate attached to it. So review is also a form of assurance, but it is a lower form of assurance. So audit is the highest form. Below that is review. They all form under the umbrella of assurance. Assurance means मैं जिसको report दे रहा हूँ to the company that I am targeting this report or addressing the report, besides my client, others are going to rely on it. It may be the tax department, it may be the ROC or the MCA, or it may be the bank or any other agency. So very important for us to understand there is a difference between audit review, which fall under the assurance framework. And then there are non-assurance services and related services. such as the one Pramod ji mentioned when he talked about compilation. मुझे provisional financials देने हैं. So therefore, it is not auditable or not subject to audit under Income Tax Act. Then I can use the compilation. So why I am explaining this to you at the beginning is because the FRRB only reviews general purpose financial statements. That means statements which are published, available in the public domain of companies, that is listed entities or their subsidiaries, and which are selected suo moto. What does suo moto selection mean? ऐसा नहीं है कि Aniket is the FRRB chairman this year and I think कि यार कैनाश पथारे जी ने मेरे को अच्छा नहीं बताया पुणे में तो मैं उनकी कंपनी कौन सी ऑडिट की हुई है उसका रिव्यू कर लेता हूँ. No, as FRRB Financial Reporting Review Board, we pick up financial statements on a suo moto basis on a very scientific method of random number selection. As chairman, I also don't know which are the companies that can get selected. There is a list of all the companies that comes and I only pick the random number. Behind that are companies which get selected on suo moto basis. So one is suo moto, which the board selects, but with full transparency, no bias. And second are companies selected as a special case. What do I mean as special case? These are companies which either comes to the attention of the board through the secretary or through the president's office or through newspaper report. I can give you a small example. Recently, there was a large bank and the private sector which was under the newspapers for various time. There was RBI enforcement on it. So those companies get picked up by the FRRB. So every year there are certain which are picked up as special cases, which are referred in the media or by the secretary's office. That can be one portion. And then the other is suo moto selection. That is one part of our activity. But the more important part, which I feel, and which is why I'm here today, is to create awareness. Because it is not the institute's role कि जिसको गलत किया उसको punish करो और सूली पे लटका दो. No. I believe as council members, Chitley ji will agree with me, Pramod ji will also agree that our role is of including and the spread of these standards, increasing it, spreading awareness so that these mistakes, what I like to say is भूल से भी किसी से भूल ना हो. जो आपसे भूल से भी भूल नहीं कब होगी जब आपको मालूम है आपको क्या follow करना है. In the disciplinary mechanism, what we are seeing is majority cases that get referred. In fact, the auditor does not want to be grossly negligent or does not want to have the company which is committing a fraud. But because of his lack of knowledge of these standards, of how you audit, more importantly, how you document your audit, that is missing, which leads to this problem. So our objective at the board is to create awareness regarding the accounting standards. There is the accounting standards under the Companies Act, the erstwhile standards, which are now applicable even to partnership and other entities. And then there is Ind AS, which we are doing right now. So a large portion of our role as FRRB, and I see especially that as chairman, and I'm coming to you directly after completing my full day's board meeting, where we reviewed 6 to 7 listed company financial statements over the past 2 days. So I'm saying this with utmost sincerity. Our role is not to just punish. That may be one part of it, but the main important objective is to create awareness of these accounting standards, the erstwhile standards, and the Ind AS, the standards on auditing, the statement on CARO, which was very well dealt with in this 3-day series, and other reporting obligations. For example, Schedule 3 of the Companies Act, which mandates us the format of financial statements. So all of those are verified by us, which we do through awareness programs, webcasts, etc. As you are aware, the ICI's motto is to be a partner in nation building. And how can the ICI become a partner in nation building? I think the FRRB is our first line of defense. For all our members or chartered accountants who are in practice, I would request you with folded hands. The last slide will show you there are 3 publications of FRRB, which have listed all the non-compliances that have been noticed over these years. If you simply go through them, I can assure you 99% of your client cases, you will never get picked up for any problem. It may be FRRB, it may be QRB, it may be the NFRA, or it may be MCA, SFI, or anybody else. If you follow these, at least on the face of our financials, you cannot make these errors. And ICI's role as a partner in nation building is to make sure that our value as chartered accountants, the value of our signature as chartered accountants keeps increasing, and we play the true role of partnering in the nation building activity by providing correct financials, correct and reliable financial information. In that role, regularly, the Election Commission of India works very closely with the FRRB. We have received the accounts and the audited balance sheets of various political parties which we are reviewing. These then get published in terms of there is a publication for our political parties of following the accounting, and also we meet with Election Commission of India to discuss the issues and non-compliances which we notice in these financial statements. That is a very important role that is played by us, along with supporting in the QARC of SEBI, where they do the quality audit for these listed entities. So not just with Election Commission, but also with SEBI. The composition of the board this year, for example, it contains of not only council members, and please, very important for all of us to note, we have only members which are some council members. The president and vice president are also not part of the FRRB. And that is with a very clear intention that even they, because they are members of the disciplinary committee. Chitley sir is a member of the disciplinary committee. He decides and adjudicates on cases which get referred to him. It can be through a complaint, it can be suo motu taken up by the director discipline. But because sir is in a deciding position, he is not a part of FRRB. So these are the very clear China walls which our institute has laid out to make sure that there is no undue bias.
But we continue to be friend of Chairman FRRB.
That is absolutely a 100% statement of fact, sir, and I will not deny that I myself seek a lot of guidance from Chitley sir. In fact, today we were discussing certain aspects of the CGCLC and how we can take sir's help in certain disclosures that we as the board also couldn't finalize on. So definitely not just technically, but also very, very dear senior friend of mine, Chitley sir. So that is what I was trying to explain. Our board's constitution, sir, it is consisting of the council members of ICI minus the president, vice president. We have government nominees. Even today, when we were attending the board meeting for both days, full time we had members present of the CNAG's office from IRDA. We also have SEBI nomination and CBDT who come from time to time and attend the board meetings. So this is the overall composition. Which are the enterprises that the board covers? Well, whose debt or equity is listed in the stock exchange. That means primarily listed entities that are there. All banks, it may be cooperative banks, and this we have been doing from the long time. Cooperative banks, though not listed, are reviewed by FRRB. All financial institutions and insurance companies are reviewed. We also pick up for review all commercial and business entities whose turnover exceeds 50 crores in the immediately preceding financial year, and the holding and subsidiary countries of companies of any of these. So for example, if there is a listed entity and it has a subsidiary, we will also pick up the subsidiary for FRRB purposes. We are not in the process of reviewing tax audits or small audits. And the reason for that is there is a separate board which is Tax Audit Quality Review Board, TAQRB. So like the FRRB does general purpose financial statements, the tax audits that you and me sign for small firms, that may be proprietor firms, it may be partnership firms, there may be small trusts, all of those get picked up by that board. But for companies, the corporate audits are done by the FRRB. What is the process of review of general purpose? Well, we look at generally accepted accounting principles. That means you have followed the standards, which can be very clearly made out by looking at the financials. We look at the financial and we can clearly lay that yes, this standard has not been complied with. For example, there is a company, we can clearly see from the salaries expense, which is into crores of rupees, that there may be more than hundreds of employees which are employed. But there is no disclosure relating to employee benefits, that is AS 15. In that cases, what we do is we immediately are aware that there is a accounting non-compliance which can immediately be picked up. So generally accepted accounting principles, disclosure requirements, what are these? The Schedule 3, for example, requires us to bifurcate between current and non-current. So some of the financial statements, whether they are observing that, the Schedule 3 also has a lot of other disclosure requirements of how you must have your balance sheet format, other notes to accounts which are mandatory to be made a part. For example, auditor's remuneration, how it has to be broken out. All of these are given in the Companies Act. And also the reporting obligations of the auditor. What is that? SA 700 mentioned by Pramod ji, which is applicable to all these companies. It is the Caro report. So even the Caro report, its compliance. So if you tomorrow mention in your audit report that as per the commit or a letter received from management, we hereby certify that there are no loans and advances. Sorry, it cannot work. As an auditor, you are supposed to have reporting obligations under CARO. You can, yes, state as per the information and explanation provided. You can state that you have done certain procedure. But what you cannot do is simply say that management said this and this is therefore part of my CARO report. If physical verification of fixed asset has to be done at a regular time and interval, you cannot say management has told us that we are doing it on a regular basis. That will not suffice. Your reporting obligations under your SA 700, under CARO, under your reporting requirements of IFC now, which are there as a part of the report, and going forward next year is going to be a revised CARO. It is going to be very clear and categorical. It has to be very specific, and you cannot simply rely on the management. So accounting, disclosure, and reporting, all three are verified at the FRRB level. Like I mentioned, it is suo moto, that is we pick up on a random basis. It can be referred by a regulator, RBI, SEBI. This year, for example, we have received a lot of liquidation companies, that is companies who are under IBC referred to liquidation, and IBBI, which is not there in this slide because that regulator is recently developed. That IBBI has sent us a list of companies which have gone into liquidation. So from that also, FRRB this year has picked up 25 companies where we are going to review those financial statements of 1 year prior to the liquidation. Because generally that is when we can see the sickness appearing. We can see whether the company's auditors had actually started flagging off, for example, going concern issues, whether all other important highlights were being done by auditors in that. And like I mentioned in the beginning, the role of the ICI is of partnering in nation building, and that can only be done once we play this proactive role. So therefore, referred to cases referred by RBI, SEBI, MCA, IBBI, and this year we also have cases referred by the C&AG. Those of you who are doing government audits will know that after completion of our audit, there is an additional report that is issued by the office of the C&AG. That is a supplementary audit that is done by them. And after the supplementary audit, they are giving a satisfactory or a not satisfactory performance of audit firms. For all those firms who are found not satisfactory, the FRRB has started and initiated the review of these financials. So selected on random basis, regulatory, and like I mentioned, picked up from media reports. So this is how we are taking up. If you look at the large breakup, 3/4 of the companies are picked up on a suo moto basis. 1/4 of them, there is 25% close to, are special cases which get referred to us or we pick up on the basis of newspaper reports. How does the process of FRRB work? I will take 2 minutes for you to explain this to you. For example, you are the auditor of a listed entity. It may happen so that your company that you have audited and signed was reviewed and you were never even informed. Why? Because it only comes to you in case there is an advisory which is issued, or if the case gets referred to director discipline. But how do we determine that? So the first stage is, for let's say the suo moto companies that were selected by FRRB, we appoint chartered accountants as technical reviewer. And here I would request all of you who are participating in this program, who have certain inclination towards Companies Act, towards accounting standard, please register as technical reviewers. You can get in touch with CV Chitley sir. He will guide you of how you can register yourself and empanel as a technical reviewer. We are looking at chartered accountants with some amount of experience in Ind AS. Since this year onwards, our board has decided to increase the number of reviews by double. So we are going to review almost 150 to 200 companies in a year. And for that, we need the help of our fellow chartered accountants. So let's say one company which was selected for review, it gets assigned to one chartered accountant. Then that CA will do the technical review. It then gets referred to the FRRG, which is a group of 4 to 5 chartered accountants, academicians, who will review the work of the technical reviewer. Then it comes to the institute office, and finally the board reviews the financial statements. This is the process. So it is not that any company is picked up and I or Chitley sir can just say this is not compliance. There are 4 levels of review that happen by a technical reviewer, by the board, by the FRRG, by staff, and then finally by the board. So this is the 4 steps of the review that happen. If there are non-compliances, let's say in a financial statement we noticed AS2, AS7, AS15, all of these were not complied with. Then what do we do? Well, if there are non-compliances, but they are found not to be material. For example, the total of certain schedule was not correct. In certain notes, we found that your language could have been better. We found grammatical errors. The carry forward of numbers from the schedule to the main face of P&L was not correct. So these, if are only limited to these issues, what we do is, if you look at the right side, it says non-compliances are not material and do not affect true and fair view. Then we can simply file them if it's very small. If they have certain importance, for example, we feel that your disclosure should have been in compliance with the standard and it was not. Your inventory standard, which requires you to value your inventory, let's say it's cost or NRV, and you said cost or market value. Well, in those cases, if there are a number of such observations, we will compile them and they are brought to the attention of the auditor by way of advisory. So the FRRB will issue an official advisory to the firm, to the partner who signed the audit report, and say these were the non-compliances that we noticed. But if say these non-compliances are major, we notice that you have not complied with impairment standards, there is a huge asset lying in the company, there is no production that is happening for 3 years, and in the foreseeable future also, the director's report clearly mentions that going forward, the outlook is bleak, the future of the company is down, the market is collapsed, and still you are carrying all the assets at cost value. Well, impairment was not done, it is very clear. There can be many such other examples. For all these cases where there is material non-compliance and the true and fair view, for example, profit of 10 crores may turn into loss of 5 crores. For such cases, one, the action is taken against the auditor where the cases get referred to the director discipline. And even for the enterprise, if it is a listed entity, we immediately inform SEBI and the MCA. For a non-listed, it goes to MCA. If it's an insurance company, we refer it to IRDAI. If it's a public sector enterprise, we refer it to C&AG. So this is what the action the FRRB takes based on this. So far till date, 882 cases that have been taken. And the breakup of that, as you can see on your screen, major cases are suo moto, that is chosen by the board, not referred by a third party. And in the cases of the board that has been decided, for 63% of the cases, we issue an advisory. So here I would like to clear the myth that FRRB में case select हुआ तो सीधा disciplinary में जाएगा. It is not the case. You can very clearly see with the presentation in front of you that the advisory is issued in 63% of the cases. Non-material compliances are 16%. So we call them filed, where we don't even inform the auditor and we say, yes, overall, the objectives were met. The accounting standards seem to have been followed. There is no disclosure non-compliance. The auditor has complied with the reporting obligations and therefore they are not important. But for 17%, they have referred to the appropriate authority in cases where we find that the auditor has been grossly mistaken in terms of his application of standards or his audit reports. And if you look at the percentage of non-compliance, a very important chart for all of you to observe, because it gives you a standard by standard layout of what are the non-compliances. The highest non-compliance, 18%, relate to the Companies Act. And we are here in Pune, where Chitley sir is chairman of the CGCLC. And very important statistic, 18% non-compliances are Companies Act non-compliances, 7% are CARO, which is also under the Companies Act. So 25%, 1 out of every 4 non-compliance that we see relates to Companies Act non-compliance. It may be Schedule 3 disclosures, it may be 184, 185, it may be any other provisions or sections of the Companies Act which we notice are not being complied. And if you look at the standards, AS3 cash flow, highest number of errors, AS15, which I mentioned, where you are clearly seeing employees, where you can clearly see a lot of provisions are applicable of the AS15, still it has not been applied. So these are the non-compliances. In terms of publications, 3 publications that have been issued besides the articles in journal. The volume 1 covered 110 cases, the second volume covered 137, and the third volume, which was released last year, covers 223 cases of observations. So these are non-compliances as per accounting standards, which we are incurring, which we are noticing. Now, starting from this year, we have started taking up reviews of Ind AS financial statements, where my target for this year is going to be that we want to come up with the publication of Ind AS non-compliances also. So now I will first take you through the non-compliances to the standards, and if time permits, we will also go through certain Companies Act non-compliances which are relating to the Schedule 3. So I hope my screen is visible to all of you. This is a standard presentation of the board, which I'm sharing with you. One very important aspect, I think, touched upon by Pramod ji, Chitley sir will also bear me out, is why are these non-compliances being noticed? And I want to touch that core question before we looked at what are the errors or non-compliances. My personal view, and again, all of you are happy to comment on the chat if you agree, if you don't agree, but this is my personal view, is somewhere as a professional and as professionals, the whole entire fraternity, we have gotten used to this concept of formats. And that format is one word which has brought us down immensely. And what do I mean by format? When I'm finalizing a report, I will tell my article or my chartered accountant, "Arey, us company ka format nikal le." If I have to give certain report, I will call Chitley ji, "Chitley sir, ye is report ka mere ko format bhej dijiye." And that format is one thing which has actually brought this profession, whatever limitations that we are seeing in terms of people being able to point a finger at chartered accountants. I personally feel a lot of it is because of our over-reliance on formats. And let's first appreciate, as chartered accountants and as professionals, it is not for us to just simply copy formats. Today, we are in the COVID pandemic situation. We are all looking at a situation where we are working from home. Your chairman is not able to go to the branch. If this was any other year, this program would have happened at Pune branch or at a physical location, and we would be meeting one-to-one. We are doing this virtually. So it's such an extreme situation. We are in a pandemic. And here today, if you expect that scientists will also use format and say, "Bhaiya, paracetamol se dawai chalta tha, to paracetamol hi chalne do," and you start using the same format, will it work? Or do you think scientists and doctors have to invent new methods, new vaccines to prevent this, and new medication to treat people who are already infected? If doctors start relying on formats, no new medicine will come, no new cure for this pandemic will come. If architects and engineers start using formats, believe me, you are in Ahmedabad, Pune, Delhi, Mumbai, or any other place, you will see the same buildings everywhere. And most likelihood, they will look like those government buildings. Why? Because then, एक architect दूसरे architect को phone करेगा, बोले भैया 10 माले की building बनानी है, जरा format भेज दीजिए. Our job as professionals is not to use formats, sir. And therefore, with folded hands, before I commence these non-compliances of accounting standards, my request to all of you is, let's re-inculcate the habit of looking through these standards. Don't open the entire standard, don't read it, I'm okay with it. But at least awareness. अगर चार्टर्ड अकाउंटेंट के पास एक आदमी आता है, बोलता है मुझे ये सर्टिफिकेट चाहिए, आप कैसे उसको बोलते हैं, भैया फॉर्मेट है तो ले आ? Then bank will give you whatever format suits them. And then we say, how is bank asking this from me? The bank is asking because we do not know what are the formats already prescribed by institute. Somebody comes and says, please sign my ITR. Can you do it? Or is there a certificate that you can do? In my view, you cannot simply sign a certified true copy and give it, because we are not gazetted officers. That certified true copy can be given by a notary or a gazetted officer. But as chartered accountants, you are supposed to give a certificate saying that underlying information in this ITR has been cross-verified from the income tax department website. The gross total income, the net income, the tax paid has been verified from the department website. And as a chartered accountant, I'm giving assurance that yes, these numbers agree with what has been e-filed. It is not my job to simply stamp. Similarly, for prospective, CMI data 5 साल का, भैया sign कर दो, नहीं कर सकते. Go to SAE 3400, read it, and then follow that format and apply. So similarly, there are standards available. And once we get over our habit of relying on these formats and simply look at even the illustrations. In the chat I was hearing when Pramod ji was discussing, some of you were very right. SF 700, 705, 706 you mentioned. So please, standard nahi padhte, let's at least see the illustration, because those illustrations give us the clear cut guidance of what is to be done. And once we are right on that, then your chances of having these errors will stop. I'm saying this because even today, I was doing FRRB review. We had so many companies that we reviewed. And what did I see? The audit report you carried forward from the last year. And therefore, though the company is preparing financials on Ind AS, everywhere it was saying the accounting standards are in compliance. They are no longer accounting standard. Now you have to say Ind AS. Demonetization note was applicable for a year. After that, it went away. Still for 4 years, people are continuing. Why? Excel के अंदर वो format में वो table डाल दिया, तो demonetization का format चालू ही है. How can we continue with that? So my request is, I'm sorry if I offended anybody. I didn't mean to say it in that way, but yes, somewhere if we recognize the value of other professionals as doctors, engineers, or architects, for chartered accountants, if we think that we have to increase further our standing in the profession, rather in the society and in eyes of everybody else, the regulators, our clients whom we want to pay as well, we have to be very clear and say that this is not a format. I have to go through my standard and then issue a report. I have a UDIN that I have to take out, and only then we will start probably getting the true value for our services. So with this, I would now like to take you through the common non-compliances in the standards. We will go standard by standard, and I will try and take you through the most common non-compliances, not compulsorily going through all the slides. So what are the common non-compliances of AS1? Well, the most of them relate to para 24, which is the main principle regarding the disclosure of accounting policies. In fact, you will be surprised, in non-corporate entities even today, so many chartered accountants are signing partnership firm and proprietorship firms audits without even giving notes to accounts, without disclosure of accounting policy. It's a criminal offense, if I can use the word lightly. Please do not do it. This is one of the most basic standards applicable even in income tax audits and Companies Act, especially because of the AS1. The 24 is the main principle, and then nature of accounting policies have to be disclosed. Let's take to the practical examples. The most common one here is, in relation to AS1, was the unrealized loss on outstanding derivative contracts have not been recognized in the books of accounts, considering the principle of prudence as enunciated in AS1. So this is what was mentioned in the notes of accounts. Now the FRRB reviewed these financials. This is common mistake that we see across many financials, and is very clear as per para 17 that prudence norm prohibit recognition of future expected profit. So prudence means I have to be prudent in not recognizing future profits. That is why contingent assets are not recognized. But this is a clear recognition of future expected loss. That cannot be incorrectly interpreted. So therefore, please correctly interpret prudence as the principle, which is an underlying principle enunciated in AS1, but it is only for losses that you have to do it. In case of gains, you do not book it. Now, we refer to the subsidies granted by government in telecom companies. Again, not very relevant, so I'll try and take you only through the most common ones that we encounter in day-to-day practice. Accounting policy on revenue recognition. What was mentioned? The accounting policy on revenue recognition states revenue is recognized on accrual basis. Cash or accrual is a form of preparing your financial statement. That cannot be your policy. Your revenue has to be recognized. If you are following AS9, then say when risk and rewards are transferred. You cannot simply say it is recognized on accrual, cash and interest on bank deposits and dividend is on cash basis. That is not a policy. Your policy has to be very clear that it has to state the timing. When do I recognize revenue? When risk and rewards are transferred. Correct? Even similarly, in the case of power transmission, you have to be very clear. This example talks about power transmission. You have to explicitly explain when will you recognize revenue. When you sell the power to the person, when you invoice him, that has to be very clearly laid out as per AS1. Most common non-compliance of AS1. These are 5 or 6 standards which most of you should hopefully be aware of. They are there. You may have a small interest expense. You may not have a capitalization of interest, that is through borrowing cost, but interest expense ka line item hai. Then sir, borrowing cost as a policy has to be very clearly laid out, because borrowing cost AS16 doesn't just talk about capitalization of interest. Even what you park in revenue has to be covered. So lot of the companies that come up for review, we are noting that there is no disclosure for borrowing cost. Inventories, and what are the changes in inventories? We'll discuss them one by one. Investments, we see that they have invested money in shares. They have investments in mutual funds. But what is the basis of recognition as required in AS1 para 24 is absolutely absent. Employee benefits. It is not that if you have only long-term employee benefit obligations, that is to stay gratuity or leave encashment, that AS15 becomes applicable. Earlier, AS15 was retirement benefits. 15 years ago, it was renamed to employee benefits. Why? Because even your salary expense, which you incur on a day-to-day basis or a month-to-month basis, that is also covered by employee benefits. So similarly, these are all standards where we see people do not put accounting policy. My request to all of you is ensure that there is a significant accounting policy for all of these items. If you have a small interest expense, still you must have a policy for this. If you have small investments, you must have a policy which lays out the investment. What should be these policies? We will discuss them in the slides going further. Similarly, impairment of assets. 9 out of 10 of your clients, you may not be doing impairment because it is not required. It's a cash generating unit. There is good surplus. But the fact that you have tested for impairment, you have to mention in your accounting policy. So when we look at these financials, there is no policy itself for impairment of assets. So that is missing. And finally, AS29, provisions, contingent liabilities and contingent assets, all these get missed. So those were the major non-compliances relating to AS1. Accounting policies, please ensure for all major heads of income and expenditure, especially which there is a corresponding standard to it, such as borrowing cost, employee benefits, impairment, you should always have a policy. What are the non-compliances then when we deal with AS2? Well, maximum of them deal with, of course, the para 26, which deals with disclosure. Why? Because this standard is just measurement is one part, cost or NRV, whichever is lower. But how do you disclose that is a major part of it. The cost formulae, which is what? FIFO or LIFO. So many balance sheets I can share with you, friends, where they would have said inventory is valued at lower of cost and NRV, full stop. The cost formula, the cost of purchase is not mentioned. So these are all the challenges that we are seeing in terms of the non-compliance. What are the example? Some of them that I've shared with you on the screen. People say stock of cards are valued at cost and on FIFO basis and include all applicable overheads. Now, first of all, how can you value at cost? It has to be cost or net realizable value. Next, work in progress is valued at direct raw material cost and appropriate cost of completed process. How did you determine it? Nowhere is it mentioned. Raw materials are valued at average cost or at raw material cost or estimated cost. Now, these are all common non-compliances. It has to be very clearly noted that NRV has to be considered in your policy. AS2 mandates cost or NRV, whichever is lower, and that must be mentioned. Please don't say market value. Both have different meanings and annotations. It has to be cost or NRV, whichever is lower. And in the cases given above, it was clear that the accounting policy clearly was in violation of AS2 para 6. What are the other non-compliances that are noted in AS2? Well, there was a guidance note on treatment of excise and duty. I will not touch upon this because we are in the GST regime. But yes, the excise duty treatment as per the guidance note which was required of recognizing the expense and the inventory without at the time of manufacture was missing. So we will not discuss that since we are in the GST era. Very important. Cost formula of inventories. Paragraph 16 and 26 of the AS2 require us to mention the cost formula. The annual reports, how were they worded? It simply stated inventories are stated at lower of cost or NRV. Cost is determined on weighted average oblique FIFO basis as a considered appropriate by the company. Please understand, how does the user of the financial statement appreciate what is it that you have done? Raw material में FIFO लिया, closing में weighted average लिया, कौन से class of asset में क्या apply किया? Simply by stating this line, you are not giving the correct disclosure. Similarly, just stating that cost of inventories is computed on average, weighted average oblique FIFO. These are all non-compliances. You have to be very clear and categorical when you mention that cost formula has to be given in these cases, but you have to disclose which is applicable for which class of inventory. Raw materials have a different class. Please mention raw material on FIFO, finished goods on weighted average, because if you have SAP and you are following weighted average, fair enough. But the fact that even in SAP you are using weighted average, that has to be covered. Even today, many of our chartered accountant colleagues are making errors and not rightly mentioning the cost formula. You are simply stating cost or NRV without stating FIFO, LIFO, which LIFO is obviously not allowed, but FIFO or weighted average, what was applied is not mentioned. It is these non-compliances that lead to trouble for our chartered accountants. So please always bear this in mind. We now move to AS3. AS3 non-compliances. Well, the cash flow statement in the report of a bank, it was noted that decrease in investment was disclosed under the head cash flow from operating activities. It is a bank and it was noted as cash flow from operating activities, and investments, that such investments were also included held to maturity. So if you're doing bank audits, branch audit or at the central level, you would have seen that the treasury of banks hold a lot of investments. Some of them are held to maturity. Well, in such cases, it was clearly viewed by the board that only cash flows arising from purchase sale of investments which are in the nature of available for sale and HTM, that is held for trading, should be classified in operating, whereas held to maturity are not be considered for revenue generating activity. These are investment activities, and therefore you cannot, even though it is a bank, consider these items as cash flow from operating activities. If it is HTM, held to maturity, you are going to hold it up to the maturity date. Your coupon is coming on an annual basis, but the bond will be held by the bank for a period of 5, 7, whatever is the tenor of the bond. So for such investments, the cash flow activity cannot be clubbed in the operating. It has to be shown separately as investing activity. Very common non-compliance that was noticed and has been appropriately addressed in all the publications of FRRB. Similarly, in the note of non-current investments and its footnote, it has been noticed that during the year, all equity shares in the enterprise were purchased, thus making them wholly owned subsidiaries. So you have acquired shares of a company, though that companies are private limited companies, and they are now turning into subsidiaries. In the cash flow statement, the difference between opening and closing balance of investment and subsidiaries have been shown as purchase of investment. It is viewed that since such cash flows result in acquisition of enterprise, it has to be very clearly indicated that the nature of cash flow is explained, has to be not in the generic head of purchase of investment. So very important in case of acquisition of shares which become subsidiaries. Administrative and other expenses, there is an exchange fluctuation item amounting to rupees dash. So this was noted in the accounting policy that in cash flows, that administrative and other expenses, and then there is an item of exchange fluctuation amounting to rupees dash, which is netted. And the same was not adjusted to determine cash flow from operating activities. So it is very clear that enterprise, the entire amount cannot be considered to comprise only of realized foreign exchange gains, and unrealized foreign exchange gain also has to be adjusted to determine the operating activities as per AS3. You cannot simply restrict to these realized exchange fluctuation gains or losses. It has to be for both. Similarly, annual report of the company, cash and bank balances include balance in foreign currencies. However, there is no adjustment and reconciliation for exchange rate differences. So exchange rate differences has to be reported and has to be a part of the reconciliation in cash and cash equivalent. In fact, in the erstwhile standard, there is also reconciliation for all the monies that are held. If it's a listed entity and there is money that is held for unpaid dividend or for call, those also have to be separately shown as part of the cash and cash equivalent, and the reconciliation has to be done as a part of AS3. So this is also very common non-compliance that we notice when we deal with AS3. Like I mentioned, highest number of errors or non-compliances are reported in the case of AS3, that is cash flow statement. Therefore, we are just taking some amount of time to discuss these non-compliances. In case of a non-financial enterprise, under the heading financing activity, interest has been reported. So interest income has been arising due to investing activity. Therefore, they should not be netted off against each other. That is to say, if you have interest income and interest expense, you should not net them off and show them as a single item. It has to be shown separately. You'll be surprised, even today, I can share with you, we were doing a review of a listed entity, 10,000 crore turnover. And even in such cases, we are seeing today that the interest expense is shown as net, rather than showing interest income gross as an income and interest expense as an expense in the P&L. Please, if you are doing any of these audits, it may be a company or non-corporate, please always ensure that such errors do not happen and your interest expense are reported on gross for income and expenses both. Certain companies disclose dividend paid under the cash flow from financing activities. but the taxes paid on dividend, that is dividend distribution, corporate tax, is shown as a cash flow from operating activity. So here, the FRRB's view is very clear. Tax on dividend paid, that is your corporate dividend tax, should always be shown with the dividend paid under cash flow from financing activities. If the dividend is a financing activity, the payment out of it is a financing activity, then the dividend paid, that is a corporate dividend tax, should also go to the same nature, which is financing activity. You cannot club it along with operating activity. Your normal taxes, which is your income tax, may get reported there, but in the case of dividend distribution, it has to be showed separately. Also, a very common error, I'm sure there is a slide on this. We are seeing that the cash and cash equivalents total, which is on the cash flow, and believe me, these are common errors that are noticed. Sometimes may have been missed. Sometimes the client changed the bank reconciliation at the last minute and gave you a bank balance, but you already finished the cash flow. In such cases, we have observed that the cash and cash equivalent amount in the balance sheet and the cash and cash equivalent amount which was shown in the cash flow, the closing balance of both, do not tally. Now these are gross errors. How can your cash and cash equivalent on two statements of the same set of financials where you have given one single audit report be different? These are errors that we've noticed. We will move forward. This is again in the case of non-financial enterprises, so not NBFCs or banks, where increase decrease in long-term loans and advances have been adjusted as working capital changes under cash flow from operating activity, and cash flows arising from the same are shown as on a net basis on cash flow statements. Here para 15E and F of the AS is very important, which says that for non-financial enterprises, long-term loans and advances are in the nature of investing activity and cannot be considered as a part of revenue generating activities. So you cannot then simply plug and put it as an operating activity. Some entities are doing this, maybe because they want to report operating profits. Operating losses, of course, are a first trigger for an auditor or even for the entity, which challenges the going concern concept. So if you're preparing the cash flow from operating, investing, financing activity, and the operating activity shows a deficit or there is a loss in the cash flow, that immediately triggers a question in your mind about the going concern of the entity. For such purposes, people are adjusting. Please be very clear, and these amounts have to be reported as a part of cash flow from, not as investing activity, but they have to be clearly said as investing activity. Also, cash flows have to be shown on, cannot be shown on net basis, separate of gross receipt of payments and of loans, that is repayment of loans, have to be shown. So this is largely in relation to AS3. This example I have already shared with you. Cash and cash equivalents have not been tallied, that is as per the bank in the schedule of the balance sheet, and as per the cash flow, the amounts are not tallied. From the cash flow statement given in the annual report of a company, it was noted that fixed asset lost due to robbery were disclosed under the head cash flow from investment activity. So there is a fixed asset which is now referred to as property, plant and equipment. Again, a very common error, and that is why I'm just drawing your attention to it. If possible, please always ensure that you are referring to these assets now as property, plant and equipment, as the relevant standard has been changed. Though Companies Act, the schedule still refers to it as fixed asset. It is a prudent and right practice for us as professionals to refer to them as PPE, that is property, plant and equipment. So in case of such companies, it was viewed that the loss of assets due to theft or robbery is a non-cash transaction and therefore will never form a part of your cash flow statement. Yet it was seen that such losses, because if the asset has been taken away, there is no cash generation. You can sell an asset. From sale of assets, you will realize some proceeds, which is your cash inflow. There may be a loss on sale of asset. But here, just to report fixed asset lost due to robbery to plug in your cash flow, well, it's clearly a non-compliance. Similarly, certain non-cash expenses are also seen regularly to be part of the cash flow. These cannot be made part of cash flow statement. I'm going to just simply take you very quickly through all these slides, majorly because of want of time, and I would like to also take you through the non-compliances that are seen in terms of the Companies Act. Is my presentation visible?
Not so far.
One second, sir. I just switched the view of the presentation वो मैंने full screen से short किया. Chitley sir, now is it visible now?
Yes, it is visible.
Thank you. Yeah, so I will just be taking
Only
you
one
through
thing
this.
for your consideration.
Sir.
As far as this Schedule 3 is concerned, if it includes fixed assets as a recital and accounting standards use property, plant and equipment, I think schedule will override over the other notification of the MCA. So that aspect you may consider.
Right, sir. But now because the standards are also notified under the Act, because the accounting standards are actually issued under the Act, and therefore those standards are also notified. So, sir, what the view we are taking?
Yeah, I appreciate. See, in a hierarchy of mandate, first it will be the Act, then it will be schedules, and then notifications. So, from that perspective,
yes,
just I'm thinking. Yeah.
Yes, sir. So, because the standards are a part of the Act, are notified on the Act. But yes, you are right. What we are doing at the FRRB is for such issues, we are not referring any of these cases either to DD or advisory. But what we are trying to do, sir, is trying to create awareness so that people start moving towards referring to these assets as PPE, because that is where the future is going to be whenever the schedule gets revised.
Yeah, so action cannot be taken. That's what I feel.
No, absolutely no. We are not taking also none of these cases. We are in fact taking any action. And like I mentioned, sir, for these cases, there is three hierarchies. We can either drop the case. Here we drop the item. We don't even refer advisory, leave alone mentioning it to director discipline. So that we are observing for all the cases where we are seeing this. But yes, as a part of the outreach as FRRB chairman, I would suggest that since you are following the standards which have been issued by the ICI, it is advisable for us to move towards this new nomenclature of PPE.
Yeah, actually, NAFRA standards, MCA standards. Yeah.
Absolutely, sir. So AS3, like I mentioned, one of the highest non-compliances that have been seen, and I've tried to take you through some of the common errors that we are seeing in terms of the compliances in AS3, non-cash expenses, foreign exchange, interest getting netted. So these are all examples that was noticed in non-compliance of AS3. Well, AS4, which deals with contingencies and events occurring after the balance sheet date, very important for us as auditors, especially in this COVID era. I'm sure you have been over the past 3 days taken through the standard of AS4, the SA 590, which deals with subsequent events, and the role of auditor after the completion of the financial statements signing date, that is 31st of March, through the date of your signature. As a part of our audit procedure, we are compulsorily required to test subsequent events. And here it becomes very critical, because a lot of the times you will see in the cases of your clients, for example, that they have taken a finance which was ongoing, and then they have gone for the moratorium. You may end up signing the financials, let's say in November, by the time moratorium is lifted. And if you see that on lifting of the moratorium,
the GM date is not extended as of today.
So that is our expectation from CGCLC. Also, I'm given to understand a lot of chambers have also requested, sir, for extension.
Yeah, representation is made by us, but as of today, it is not extended.
Yes, sir. But I'm hopeful and confident, sir, this year, since the government has gone ahead and made a lot of extensions, suo moto, it may be the income tax filings or GST or all other due dates. Hopefully, even here, they should be a little considerate, because companies have not been even able to write the accounts. So the audit and the other part comes only later. So in such scenarios, if let's say your financials get finalized, subject to Chitley sir getting us the extension that we are all looking for, and then we don't need the UDIN extension also. I'm sure all of us understand what I'm talking about. So then the UDIN extension not coming through, the Companies Act extension being in place, you are seeing, for example, that the company has defaulted after the moratorium period. Well, that is a subsequent event. It will be an adjusting event for you to report in your financials. So what I'm trying to tell you is these are all very important aspects of your audit. You cannot just simply restrict your audit to the balance sheet date, but events that occur after the balance sheet date. The accounting standard as well as the standard on auditing provide for these adjustments, which must be taken into effect. Here, there's one example that has been highlighted. In case of notice of accounts of the company, the policy to take into impact any significant occurs at balance sheet date before the finalization of accounts. That was the word that was used. But it is viewed that events occurring after the balance sheet date are those significant accounts that occur between the date of balance sheet and the date on which the financial statements are approved. Correct? So your date for consideration is from the date of balance sheet, that is, let's say 31st of March, till when the board of directors approve the financials. So date of financials finalization is not a term which is anywhere defined either in the Companies Act or in the standard. And to simply state that I have restricted my verification from balance sheet to finalization. कि मैंने मेरे तरफ से finalize कर दिया. I initialed the trial balance. The accountant signed the trial balance and gave it to me. That cannot be a statement. You have to be very categorical, and that is why I was referring to the subsequent event standard, where up to the date of your signing the audit report, you should ideally look through the subsequent events. For audit, it may be as simple as looking through all the large payments that have occurred. For example, the bank statements, the bank book, if it has been updated and written by the client, please go through the 2021 accounts also. There may be cases you may see that is a large legal fee being paid, and immediately it will strike to you as an auditor that why is this legal fee? And it may turn out that it relates to some important event that happened in the prior year, which generally in your scrutiny of ledger or your vouching will not come up. But if you are able to verify this after your balance sheet date through your signature, then yes, there will be reportable items which come to your attention, which may need an adjustment as of the year end. Therefore, very important standard, non-compliances are not there as much in terms of the FRRB, but very important for us as auditors. We now move on to the next standard, which deals with AS7, AS4 we've covered, AS7 construction contract. Again, a very important standard applicable for construction contracts, all contractors. Here, majority of the non-compliances either deal with recognition of contract revenue and expense or with the disclosure requirements that are inherent in this standard. Most common error, job work revenue is accounted on the basis of running bills raised and approved by the clients. Generally seen in the case of government contracts where there are RA bills, that is running bills which are approved. As soon as it is approved, what your accounting policy of the company was stating was that job work revenue is accounted on running bills basis approved by the clients, and revenue expenditure is accounted on accrual basis as and when it is incurred. Now, how can you have a policy which is directly not in compliance with the AS7? The AS7 has very clearly in the para 21 requires you to recognize revenue and costs based on the stage of completion of the contract. So your RA bills may be a certain amount which may be approved or not approved, but if your, let's say the entire project cost was 10 crore and 60% was complete, then based on the percentage of completion of method, you are supposed to recognize the expense. You cannot have a simple policy which states that you are recognizing on the basis of RA bills. It will be clearly in violation of AS7. Similarly, from an annual report of a company, it was noted that the company involved in construction business, its schedule of inventory also includes job in progress, that is construction in progress or work in progress. Yet there was no disclosure that was made in relation to the method of accounting for such contracts. So for construction business, you have to compulsorily make sure that you mention the aggregate amount of cost incurred and the profits that you've recognized up to the reporting date, that is 31st of March. The amount of advances received. If your client is into construction, they are building, there may be certain units that they would have sold, and there are advances that you've received against certain bookings. These advances have to be clearly shown in your financial statements. You cannot simply just put everything into a job in progress as was done in this case and get away with it. And also, if there are any amount of retentions, those have to be very clearly laid out as required under para 39 of AS7. You may be finding it a little simple that how are these non-compliances, but believe me, there are over 1,000 non-compliances that have been reported, and you'll be surprised at how frequently these non-compliances keep coming in the case of company audits. So kindly go through all of these non-compliances. Some of them you may also find in the cases that you yourself are auditing, that the standard, the policy disclosure or the relevant disclosure as per the standard is not made. We now deal with AS9, one of the most common again errors and most important standards when we talk about the size of its impact, because revenue generally is the largest number on the P&L, and therefore the revenue recognition as a accounting standard becomes all that more important and relevant. Your disclosure of it, the definition of revenue, how you recognize it. For services, how do you recognize revenue? And uncertainties, if they exist, how do you account for it? We'll just go through some examples to try and better understand this standard. From the annual report of some companies, it has been noted that one of the items of income as shown in the statement of profit loss is advertisement and ticket sales. And what is the accounting policy stating? Revenue from sale of tickets is recognized when the tickets have been sold. Advertisement revenue is recognized when advertisements and net realization are confirmed. Now, from this statement, can you make out as to what is the timing of the revenue? It is noted that the enterprise under review renders services. And for services, revenue from sale of tickets should be recognized as per completed contract method. Accounting policy that was adopted in this case is when you sell it, you are recognizing it. It is also to be noted that in case of advance booking of tickets, so let's say there is sale of tickets that the entity is doing. There may be cases where you sell before the activity or the event happens. There may be a movie theater and you sell tickets 1 week in advance. There are certain shows, there are certain events that happen where tickets are sold months in advance. And there is always a time gap between when you sell and the actual event occurring. Such events cannot be recognized as revenue, because when you sell a ticket, let's say there was an IPL ticket that was issued, and if simply on the basis of sale of such tickets, your accounting policy required you to recognize the revenue, you would recognize the entire revenue on the sale of tickets, and then suddenly a pandemic comes, the entire matches are cancelled, and you are then left to refund this amount. If you've already charged this to revenue, it becomes an extremely complicated case for you to reverse this. Same principle also applies for advertisement. If you have received some money for advertisement, but till the advertisement is actually run, you can actually not book the income as per AS9. So one common example of how non-compliance of revenue recognition in services happens. Similar example is given here in case of revenue from online education services. Again, very common fact that is happening these days. Your institute also is engaged in providing a lot of education services now online. You are all seeing that our inter and final courses are now being done online. Faculty courses by the Board of Studies being taken online. Even the CPE events, the branches organized online. We now have a digital learning hub, a full-fledged portal where all certificate courses are also being done online. So huge shift and change that is happening even at the institute level. Here in the case of a company, the policy stated that the revenue from online education services, if charge is recognized upon receipt of subscription fee, otherwise apportioned over the subscription period. So let's say it's a 12-month subscription, you are recognizing the receipt of subscription fee over apportioned period. Revenue from online education is recognized upon receipt of subscription of fees. This is what the accounting policy simply disclosed. From the above, it was viewed that period when the services are rendered should be considered. That means when does this period relate to? Simply taking the money, which is going to be, services are going to be provided over a period of 12 months, 9 months or a 6 month subscription, then you have to prorate the income over this period, and only then the income has to be offered. So these are certain non-compliances that we are seeing in terms of the AS9. I will try and now be a little faster because I would like to take you through all the standards in certain Companies Act non-compliances also. So here, accounting policy with relation to dividend. Dividend is accounted as and when received. Income and expenditure are recognized on accrual basis, except dividend on shares and units of mutual fund, which are recognized on cash basis. So this is absolutely not true. You cannot please state that dividend can be recognized as and when received. If this is the policy that our client is following and this is the notes to accounts, it will 100% be a non-violation. It has to be clearly stated as per para 13 of AS9 that dividend is to be recognized when the right to receive payment is established. So when I have the right to receive it, only then can dividend income be booked. You cannot simply state that cash basis pe aa gaya. If the board has approved and your right to receive the dividend is established, that is the period at which you must recognize this. Very important, when you're recognizing revenue or disclosing that accounting policy, you must cover this aspect. Similarly, certain accounting observations where people have mentioned revenue, income and cost expenditure are accounted on accrual basis. Now, accrual basis is simply a method of accounting. Your timing of revenue, which is required by the standard, that is when the enterprise has transferred significant risk and reward to the buyer, that has to be disclosed. When you are selling a product, simply the material leaving from your factory, but if the risk and reward is not transferred, you cannot recognize that as sale. But if the contract provides that risk and rewards after it leaving the factory, belongs, if it's a CIF purchase, then for such cases, if it belongs to the buyer, risk and rewards can be established to be transferred. Only then can you transfer the revenue. And please ensure that your revenue recognition also clearly states this in this exact manner. AS 11 deals with foreign exchange. Again, not very common, so I'll not touch upon in great detail. Just certain one or two examples. It was noted in certain company that there are foreign exchange transactions. You could clearly state it, but there was no policy of how the foreign exchange gain or loss is to be recognized. Simply a line item of foreign exchange gain was present. Violation of AS 11. Here there were export sales, and which were simply mentioned that they are recorded at a rate notified by the customs for invoice purposes. Now export sales have to be recorded at the rate notified by the customs instead of translating the same on the basis of exchange rate prevailing on the date of transaction. This is not in line with the AS 9, para 9 of AS 11. So a lot of non-compliances that relate to forward contracts, hedging contracts for AS 11. I'm going to leave this presentation with the branch so that you can go through all of these non-compliances in a greater detail. We will now move to AS 15. Again, after AS 3, one of the largest non-compliances that we are noticing at the board is in relation to the employee benefits. Why? Because the standard was changed. Some of us are still used to what I refer to as formats and carrying forward the same format of balance sheet and profit and loss account and notes from prior years. Maybe when we did our articles and the format our principal followed, we have simply carried forward that Excel file and continued in our life. Sir, this standard has changed. There are requirements very specific in the employee benefits, and let me explain them to you in very short. The employee benefit standard no longer just deals with retirement benefits. Your month-to-month payments of salaries, your annual payment of bonus, all your other employee benefit related expenses, staff welfare expenses are all a part of AS 15. And what do I mean? अगर gratuity और leave encashment company में नहीं है, मतलब मैंने इसका कोई note ही नहीं दिया, it is not done. Your employee benefits have to very clearly identify short-term employee benefits, long-term employee benefit. Short-term employee benefit क्या हुआ? जो आप salary देते हो month to month. तो आप लिख दीजिए they are accounted. This is short-term employee benefits include salaries and they are accounted on this basis. Long-term है, gratuity है, leave encashment है, you get an actuarial valuation done. Based on the actual valuation, there is a provisioning that is to be done on the books of accounts. And very important, even for smaller companies which get picked up, we are seeing the threshold for application of AS 15 is achieved, but disclosures are absent. Therefore, we just go through what are the standards. But like I said, short-term as well as long-term employee benefits must be clearly distinguished, disclosed, and the policy mentioned. The highest non-compliance again related to defined benefit plan. So there are defined benefit obligations and there are defined benefit plans which we take for our employees, and their disclosures are found to be insufficient. The accounting policy relating to employee benefits simply states annual contribution in respect to provident fund are made to LIC and accounted on accrual basis. Well, this is not sufficient. Just paying to LIC and mentioning that is not done. Para 45 of the AS 15 clearly requires you that expenses of defined contribution plan should be recognized for each period of service. That is every financial year of service of the employee. On that basis, they have to be on the basis of rendered by the employee. The accounting policy should state that the expense has been recognized when the expenses made in the fund. What do I mean by that? If there is an employee X, based on his working with the company ABC Limited, and the company X has been working for 7 years. This is his 8th year of service. Based on his association of past 7 years, this being the 8th year, his likelihood of continuing with the company for let's say 15 years, 20 years, and then there will be a liability for the company to pay him gratuity. You cannot simply say that I have today paid so much LIC and that will be my expense. The standard requires that the actuarial valuation is done based on his association with the company. The actuary works out his liability for current year, that this year's service ka aage jaake kitna liability hoga, and that actuarial estimation is done and that has to be provided in the P&L. So that policy is in compliance with the AS 15. Simply stating that contributions to LIC on accrual basis will not be sufficient and will be viewed definitely as an advisory material for FRRB. Para 47 explicitly requires disclosure of amount recognized as an expense for defined contribution plan. So you must always separately disclose what is the amount that you have made towards this employee contribution plan. The actuarial risk has to be clearly laid out. It has to be shown, stated. The assumptions that are there in the actuarial assumptions also have to be tested by you as an auditor. Simply stating that provision is made in the accounts and considered as a notional date of retirement, well, these are standards, these are certain disclosures that were seen. These cannot be continued. I think there are certain questions being asked at the chat box. We'll probably answer all of these questions at the end and I'll take them up together. So AS 15, again, my request to all of you, even if there is no gratuity, leave encashment, there may be short-term employee obligations that all organizations have. It is in the nature of salaries, wages, staff welfare. The AS 15 does not only deal with long-term employee benefits, which are defined contribution plans. It also deals with short-term employee contributions. And how do you recognize salary? On what basis are it booked? That must also be clearly indicated in your accounting policy. So AS 15 deals with that. AS 16, again, borrowing cost, not just capitalized borrowing cost, it also talks about regular interest expense. So when we say borrowing cost, we talk about interest expense debited to P&L, which is revenue nature. And then there is interest which gets capitalized on qualifying assets as per AS 16. That has to be separately disclosed. Certain examples that I would like to take you through of non-compliances that have been noticed. Accounting policy of valuation of inventories stated that finished goods are valued at cost of lower of cost or NRV. Cost includes depreciation, interest, and direct expenses to the point of stocking. Now, as per AS 16, no borrowing cost can be capitalized unless such inventories take a substantial period of time to get ready. So it has to be a qualifying asset. Inventories by per se are not qualifying assets because they are sold in day-to-day trade. And what are substantial period of time? If you look at the ASI 1, it clearly states more than 1 year. So if the period for you, it takes substantial period, which is more than 1 year for you to realize, only then for such assets you can capitalize. So let's say I'm putting a new project. In the new project, I'm incurring certain expenditure. There is a borrowing cost associated with that. That part of the interest, if that new capex is going to take me more than 1 year, it's a 3-year, 4-year, 5-year project horizon, then such interest can be capitalized because it takes substantial period of time. But if you're expecting that within 3 years, this project, 3 months, this project will be completed. If it is in the nature of inventory, then interest cost cannot be capitalized. So these are certain examples of the AS 16, that is by borrowing cost. In terms of the segment reporting, well, it is very important. Most common error is people only refer to one segment and say, company mein aur koi segment nahi hai. I only do power trading. Power is one segment. Segment, there are two parts, business segment and geographical segment. If in case of your company, there is an export, that export is more than 10%, it will, and it's a different geography. Therefore, you can have to not only state the different business segment, but also identify a different geographical segment and state this is in India and this is outside India. When I talk about outside India, obviously that is export. So important for us to appreciate and understand the definition of segments and not just restricted to business segment, but also geographical segment. Also in the reconciliation, segment revenue should be reconciled to enterprise revenue. When you show 3 segments and that 3 segments total to, let's say, 50 crores, that should also tie into your financial statements revenue number of 50 crores. Because if that doesn't tie in, then there is no point of giving a disclosure. You are giving segment reporting, but the totals do not agree with your financials. That doesn't help the use of the financial statement. So reconciliation is important, and you have to very clearly identify these segments. Like I said, in the MIS, if there is different business reporting segments, power generation is one, manufacturing is other. Naturally, it is a segment. But if there are geographies involved, those also become secondary segment, which we call as the secondary geographical segment. AS 18, related party disclosure. Again, huge errors noticed simply because of understanding of the standard. most important, transactions were of material nature. It could be made out that they are done with related party, yet no disclosure. The disclosure of the related party, that means you are not mentioning either the relationship, you are simply saying XYZ related party, XYZ limited. Now, how is XYZ related? It is either a subsidiary, it is either your holding company, it is an associate, it is a joint venture. So identifying and mentioning the relationship of the related parties, very important. Now, a lot of companies where the disclosure statement is tried to be summarized and relationships are not mentioned. KMP, the key managerial personnel, have to be clearly identified, and their payments, it may be managerial remuneration, director remuneration, that has to be clearly given. Where control exists, so there is same control between two entities, those are also to be disclosed. These are all the common non-compliances that we are seeing. What are the annual reports stating? The phrase in certain annual reports, other related parties, has been used other than giving specific relationship. So you mention companies, ABC Limited Holding, PQR and HSM subsidiaries, and then you mention a company called AJP and say other related party. It cannot be done. You have to clearly mention what is the relationship. You can say there is common control, so the control exists, there is common control, it is an associate, it is a joint venture, but the relationship must be very clearly laid out. Similarly, the KMP, like I discussed, have to be very clearly given. The chief executive officer, who is the likely to have very important role, then he has to be identified as KMP. You may be paying him crores of rupees of salary, but certain times they are not disclosed as KMPs in AS 18, cannot be done. If any transaction with an individual party constitutes 10% or more of the total related party transactions, then it is a material transaction. And such material transactions have to be mentioned. The volume of such also needs to be clearly mentioned in your balance sheet. So this is in terms of AS 18. The EPS, again, very common errors that we notice in APS. Very quickly, I'll just take you to the chart for you to appreciate what are the errors. The dilutive EPS, not mentioned in a lot of cases, required as per standard. The per share diluted is also missed. Earnings per share have to be clearly given on a diluted basis and a per share basis, not given. Potential equity share example. So you can see that they will get converted into equity share in the future, yet they have not been taken for the calculation of diluted EPS. These are all common errors that are noticed. I'm going to leave this PPT like I said, and you can go through the common errors. Even for the profit number which has to be picked up for the purpose of EPS calculations, sometimes people are taking the number after exceptional items. So these errors are also commonly noticed. You must always be clear in terms of the numerator, which is what profit number has to be taken, and the denominator must be the weighted number of average shares, which it is outstanding at the year end. That has to be very clearly mentioned. AS 22 deals with accounting for taxes for income. This not only deals with deferred tax asset and deferred tax liability, even your income tax expense, that is your tax provision for the current year, gets dealt with it. So you must have a clear policy for in line with AS 22 to deal with one, your current year income tax, that is the current tax expense, and then your MAT expense, which is in case of book profit, and finally your deferred tax asset or liability if it is arising, that has to be given. There must be a disclosure of the breakup of deferred tax asset and liability. Simply mentioning deferred tax asset net on the balance sheet and leaving it as it is a serious non-compliance that we are seeing. You have to clearly break out your deferred tax asset and the deferred tax liability and show in compliance with AS 22. 23, not very common, so I'm not going to be dealing with it. Discontinuing operations. One of the entities that was under FRRB, it stated that, as you are aware, company exited the business of manufacturing fertilizers and has taken up the real estate activities. Clearly, the director's report, the audit, the financial statements, the notes to accounts have clearly stated that one line of business has been stopped. When I decide to stop a business, ऐसा तो नहीं है कि 30 मार्च को decide किया और मैं 30 मार्च को business बंद कर सकता हूँ. You will have a period before you can close it down. Your assets have to be sold. People who are in that line will have to be moved to some other line. So therefore, the requirement of this standard is, if in any of your clients, you see a line of business and which can be identified either by segment reporting or you know from its object clause that it is engaged in 1, 2, and 3 activities, and one of those activities is discontinued, then discontinued operations is applicable. Your financial statements must have a separate column for discontinuing operations, where income and expenses of that discontinuing operations are separated from the entity's regular income. Intangible assets, AS 26, very, very important. Even today, I'm telling you, so many companies, they go for an IPO. It may be a BSE SME IPO, it may be for other IPOs, and because you want to take the deduction in their income tax over 5 years for 35D, you are putting these expenses as preliminary expenditure. Please, with folded hands, I request you, the concept of preliminary expenditure has been abolished. You cannot, as per the accounting standards, have preliminary expenditure sitting in your profit and loss account and your balance sheet and written off 1/5 every year over 5 years. That is simply not allowed. The accounting standard for intangible asset has a very clear recognition principle. You will have to amortize it over the period, that is the expectancy. And preliminary expenses, because of the sheer nature, आपने कंपनी incorporate कर ली, उसका कोई future benefit accrue नहीं होने वाला है accounting wise. IPO expenses, these are all to be debited to P&L and cannot be simply carry forward as preliminary expenditure. Certain examples that I've covered here in the presentation: rental paid for pre-commencement of retail stores, factories, seed marketing expenses. These cannot be considered as a resource being controlled by the enterprise. Hence, they do not meet the criteria of asset and cannot be treated as an asset. So leave alone intangible, they are not even assets. You have to write it off to your profit and loss account. Please be very clear. Similarly, examples have been given for factory licenses and trademarks, how you can recognize it. Softwares also, if they are developed, they have to be written off over the life expectancy period of and amortized. So expert advisory opinions are also available, but very quickly, like I touched upon, important for you to understand, your preliminary expenditures cannot constitute intangibles. Intangibles have to be amortized over the useful life, and the assets which can be recognized as intangibles are very clearly laid out in the standard. This is an example: research and development expenditures. Well, if it's a research phase, then you can have it as a intangible asset, but to call it as deferred revenue expenditure is absolutely in contrast to AS 26. There is no concept of deferred revenue under this AS 26 standards. The AS 27 deals with joint ventures, not very common. So with this, I conclude my presentation on accounting standards. I have a small other presentation which deals with the Schedule 2 and Schedule 3 non-compliances of the Companies Act 2013, which I shall definitely mail across to the branch so that they can take it up. But just to discuss them in brief, these are changes that have happened consequent to the Companies Act 2013. The share capital requires you, for example, to have disclosed the rights, the preference in the restrictions on the class of assets. Lot of times that is not mentioned. The reconciliation of each shares of asset, that is being absent, which we are noticing in the case of Companies Act 2013 onwards balance sheet. Even for reserve and surplus, there have been now changes that have been made. So current, non-current, and other changes that have been introduced by this act. Let's ensure that our compliance to these standards increase. Like I mentioned at the beginning, when we were discussing these accounting standard non-compliances, we will have to get over our obsession of following formats. No longer can you simply follow format. It is going to be extremely important, and I think the duty is cast on each one of us as auditors that we refer to these standards, we refer to the act in the schedule each time we finalize. Yes, the institute will provide to you certain guidance, certain formats, but always try and make sure. For example, if you're finalizing the audit report of March 20, my request to you with folded hands again will be, go to the institute website, simply on Google type SA 700, you will get the format of the audit report, which is the illustration. Refer to it before signing. Just because your colleague, your article assistant or chartered accountant has prepared and you say dekh liya and you sign it. Last year, CAM was made applicable for listed entities. There are unlisted entities to whom it was not applicable. उन्होंने क्या किया, रिलायंस का फॉर्मेट उठाया, आर्टिकल ने बोला सर मैंने रिलायंस की बैलेंस शीट से लिया है, and CAM has been made a part of the audit report. Similarly, opinion paragraph moved on top last year in the SA 700, last year, because you carry forward with the format which was followed in your office the year prior, you are still using the old SA 700 format. So please always refer to the standard, if not the standard, at least the illustration to the end. And let's have the healthy habit inculcated in each one of us when we are finalizing the accounts. And if you do it once for your first 2 or 3 audits, if you're doing 45 or 60, whatever may be the number of audits that you are signing, if you do it diligently for the first 2, 3, I'm sure you don't have to do it again for all. But yes, for the first few, it may be in the case of certificates, kindly refer to the guidance note of certificates and reports. If it is a prospective financial statement, the standard and assurance engagements. If you are giving a review, SRS. If you are giving related services, SRE. If it's related services, SRS. And for audits, SA 700 and the auditing standards. If such compliance of these standards and accounting standards can be ensured, I am sure my role as FRRB chairman is going to be extremely easy. We will not have so many non-compliances and then not have to go into the painful process. And believe me, it is extremely painful for us as council members to refer a case for me to director discipline of my own council brother. And I think Chitley ji will be the right person to share his example of how painful it is for him, being a chartered accountant of so many years of standing, to punish one of his fellow chartered accountants, bar him from his livelihood for a period of maybe up to 1 month, 6 months or 5 years, or even lifetime in such cases. It is an extremely painful process for us to do it to our fellow chartered accountants. We hope we never have to do it. But for that, I think we all have to raise the bar and follow these standards. I thank Pune branch once again for inviting me, and my special thanks to Chitley sir for inviting me. Thank you very much.
Thank you so much, Aniket ji, for such informative session. In fact, that valuable suggestions which were discussed during your session will go in a long way to all the participants. We are really grateful to you for all your time and effort in this presentation. And this entire series comes to an end today. So may I please request C.V. Chitley sir for his valedictory remarks to all the participants, and also thanks Aniket ji for being with us. Can we take a few questions if time permits? They are mentioned in the Q&A chat box, and may I please request Chitley sir to give formal vote of thanks and the valedictory remarks.
Aniket, you will be taking up queries first.
Sir, I'll answer them in the chat. I'll answer them in the chat,
okay.
so you can please continue, sir.
Yeah.
Thank you, sir.
Yeah. Friends, as we are aware, as a chartered accountants, we are mainly devoting our time in practicing taxation matters. And as far as taxation is concerned, more and more we are forced to adopt a box type approach, that in each box you have to tick something or the other. Even tax audit report, where there is audit report is supposed to be given, you are supposed to fill up the things in the blanks. And therefore, at times our ingenuity finds no expression or no scope. But then, as rightly explained by Aniket, that you cannot dogmatically really follow the last year's format. And what I have seen, the maximum time one should spend for the purpose of drafting report is receiving the minimum time. And really it is a cut copy paste. In fact, I remember that in one Rotary Club, one party was to be thrown. So the member said that, okay, he sent a message to his president that I want to give a party, please join me for a dinner, and come along with Radhaben, because it was his wife. And then he realized that he is not having telephone numbers of all the members. So he told the president, please, on my behalf, you invite everybody. And president simply cut pasted the message received and sent it to all the members. And everybody was wondering why everybody is invited along with Radhaben. So this is the approach that at times meets with pitfalls, that you don't really read the things. Even there are cases we have seen in disciplinary matters, that when last year there was loss and this year there is profit, the current year's audit report continues that it is true and fair view of loss. So these type of the things do not really increase the esteem of our profession. And then maybe other professions are very aggressive in making certain demands. As far as corporate audits are concerned, they require more than little attention. In case of proprietary concerns, in case of partnerships, maybe they are not regulated in a sense that if you give loans, if you receive loans, if you keep on depositing your own money, etc., it doesn't matter much as long as it is appropriately accounted for. But in case of corporate audits, it is governed by so many regulations, because if not practically, at least theoretically, the management and ownership is severed. Ownership with the shareholders, and management goes to the board of directors. Therefore, in order to provide protection to the funds of the stakeholders and others, there are various regulatory requirements. Those have been placed on functioning of a corporate entity. And when an auditor is expected to give an audit report, he is supposed to look at all those things. In fact, although the audit was not topic, in case of revised code of ethics, one aspect which has come from international code of ethics is about NOCLAR, that non-compliance with other laws and regulation also requires to be seen by the auditor. Although this particular provision from code of ethics is on a hold, as far as the auditing standard is concerned, it expects chartered accountant to point out even non-compliance with other regulations. So that also I would appeal that one will have to take into account, that if supposing there is some other, say, unauthorized non-payment of provident fund for a considerable period, or any those defaults are there, or if minimum wages are not adhered to, or if you are not making provision for bonus as per payment of bonus act, all these are non-compliances with other regulations. And there may be some of the non-compliances which do affect true and fair view of the financial statements. So that also needs to be seen. Maybe FRRB also would be looking at non-compliances of other regulations. In all, as far as this complete series on corporate laws is concerned, Aniket, this is annual feature of company law. And this time it was more ingeniously structured, that we had lectures from FRRB. Although, as we understand that FRRB is restricted for the purpose of review of listed entities, maybe 50 crore plus entities. But whatever limitations you have pointed out are definitely applicable to all the entities across the board. It is not restricted only to this large entities or public interest entities. And this will definitely go a long way in enhancing the audit quality. What we have seen, that whenever there is any seminar or any program on maybe GST, maybe direct taxes, then people attend it in large numbers. But let me tell you that going forward, that tax laws are becoming more simple. They are becoming more amenable of mechanical application, and the business of return, etc. in case of GST, once when you have both the ends similar invoice, automatically the processes would give the result of whatever is your tax liability, whatever the credits you get. Maybe in case of income tax, the law has announced that we will give you pre-filled returns. As far as hearings are concerned now, those hearings would not be physical hearings as we are used to, but they will be electronic hearings, and they are sitting at night at 9 o'clock also at home. You can really respond to the queries which have been raised in hearings. So to one extent, this practice relating to tax is going to be limited. The obvious reason is the value addition is to an extent limited if you consider at macro level. Then what remains with the profession is its core, and the core is accounting and auditing. So we have to be more careful for auditing. Now, once when we pass final examinations, we believe that yes, accounting is something I know thoroughly well, and auditing is just ticking and answering those questions. It is not so. In fact, the audit will start right from the moment of appreciating what are the deliverables. So in case of deliverables, as Aniket pointed out, and as Pramod also said, that one has to consider what entity he is auditing. If it is a listed entity, maybe that key audit matters para will come. But if it is a private company, that CAM is not applicable. So those things we need to appreciate before we start the audit, not after we do the audit. So after having appreciated what is going to be our output, then you should think over all those points to be included in audit report, where you will require more inputs. Like it is usually said that in case of fixed assets, the fixed asset register is maintained. However, it is not updated. And updated means what? It is not updated only for the year or for 5-6 years preceding. That nobody attends. And then when the matter comes to FRRB, one will really find it difficult. And even if it doesn't go to the FRRB, what esteem you will be carrying with the client, that you are not looking at fixed asset register. Client also is aware that for 5-6 years the fixed asset register is not updated, and then you are saying that fixed asset register is maintained but it is not updated. That also does not speak very well for our profession. Pramod said that okay, you bill in a 5-star restaurant manner, where on a cart you get a cup of tea for 5-10 rupees, but in a 5-star hotel you will get it same cup of tea for 250 rupees. Well, and we are willing to pay for that because of the deliverance, because of the atmosphere, and because of the acoustics. So same approach we have to adopt what Pramod has stated. And there, continuing with the example of these fixed assets, if annually the auditor insists upon, no, before I conclude the audit, you complete the fixed asset register, and then only I will sign the audit report saying that yes, fixed asset register is maintained, and make the management appreciate that this fixed asset register is not for the purpose of my reporting in Caro, but it is for the benefit of the company and the stakeholders, that okay, these are the all assets which the company owns. And really for the management to take physical verification of those stocks at appropriate intervals. And for all these purposes, auditing standards are there. They have been guiding the students that maybe at least in 3 years, you should cover the all verification of all fixed assets. If it is large entity, if it is not so large entity, maybe annually one can do so. So if we insist upon that, and the management finds that maybe out of say 180 chairs, 20 chairs are missing, I think the credit will go to the chartered accountant who insisted upon having a fixed asset register and having a physical verification, and that will really enhance the value. And look at the picture of a chartered accountant, where out of 180 chairs, for 5 years he continues the remark that fixed asset register is maintained but not updated. And then you find there are 80 chairs which are missing. Definitely the auditor, the management is going to show accusing finger to the auditor. They are saying that yes, my boys were not doing work properly, but what prevented you reporting that to me and the stakeholders? So we have always to think that yes, whether the management notices or not, whosoever may notice or not, at least it is for your conscience that whenever you are certifying particular thing as true and fair, to the if you put your hand on your heart, then your conscious to say that yes, whatever you have reported is correct, and whatever shortcomings are there, you have boldly reported them. Don't worry if you put any remarks which are not very convenient for the company, because it is not the audit you are doing for the company. Maybe appointing audit authority is the management, but you are really representing the government, the stakeholders who are all going to use your report. So you should be working for them. Maybe remuneration is paid by some other entity. There are discussions going on whether the appointing authority and the reporting person should be the same or not. Maybe in due course of time, the Ministry of Corporate Affairs may also will have to answer how to really come out or answer this jigsaw puzzle. Because why at times people are not very bold in reporting, because their financial interests are also wedded to the appointing authority. But then someday the profession has already come up by standards. Someday the practical solutions also will come up, which will physically divorce the appointing authority and the reporting persons. So these will be the developments in corporate laws. As pointed out earlier, that as far as this AGMs are concerned, which are required to be conducted by 30th of September in case of financial year ended 31st March 2020. The Ministry of Corporate Affairs has allowed to hold AGMs and other meetings electronically, no need of physical meetings. And they have also said that where both is not possible, physical not possible, electronic not possible, maybe you can apply for extension, and that extension you can apply for at least 3 months, which they would be giving liberally. But then instead of that, we have pointed out these difficulties, particularly relating to the corporates, for the purpose of finalizing their accounts, because they have to examine impairment of asset. They have to physically verify the assets, the inventory, value them, consider receipt of various confirmations from debtors, creditors, ability of the debtors to make payment. And after all these things, maybe making usual year-ending adjustments, they have to finalize the accounts. So it is from the company's perspective that they would be finding it difficult to finalize the accounts. All companies are not geared up for maintaining their record on cloud storage so that access can be done from home. In case of number of companies, it is necessary to attend physically the office or the place where the accounts are kept and then finalize them. And also because the company staff is, some of them are housed at contamination zone. Maybe in places like Mumbai, Pune, they are not able to even attend offices. So in these circumstances, for corporates, it is difficult to finalize accounts in time. And this being the main reason, we have stated that companies have requested for adjournment of this particular extension of time from September to December, or maybe further. Of course, we have said audit is an added matter. It's not that because the audit, because usually people say that because the audit has not happened, we want extension. It is not the audit. It is the finalization of accounts that has not happening because of that audit cannot take place. And that's why the extension, that is the line of argument that we have put in our request to MCA. We will also be talking to MCA personally. And I'm sure that considering the liberal attitude and the approach the government has adopted in even in tax matters, because the donations which you pay till July end, they can be allowed as a deduction in March 2020, which is unheard and which is unprecedented. I think giving 3 months extension is not a very great job for Ministry of Corporate Affairs. So let us hope for the better. But let me tell you, as a chartered accountants, we are selling time. And if the time gets extended, your fees don't get extended. So even if this date is extended, try to contain your audits within September as far as possible, so that maybe you have more time left for rendering some other services to other clients and earn more fees, because this is going to be an exceptional year where your fees will also take toll. Maybe there would be renegotiation on fees. On that, I think we should have separate session from Aniket, because from where to learn if not Ahmedabad. So I'm sure that we will have some more sessions on how to charge 5-star and really realize. So friends, I thank all the speakers who have rendered really wonderful job in each of the sessions. These are useful even if you are not doing, say, audit of a listed company. Maybe if you perform on these principles in case of private companies or whatever companies you have, one day definitely listed company will knock on your door. You have to demonstrate the quality and the opportunity will definitely come to you. Let's hope so. As far as the branch team is concerned, right from Chairman Abhishek, Vice Chairman Samir, Secretary and Treasurer Kashinath and Amruta have played a very key role in coordinating this particular seminar, and appreciation is due to them for organizing this wonderful program. And particularly in Pune, Aniket, we are having 10 days lockdown, which will end after 2 days. So this lockdown is gainfully utilized by this branch managing committee team. So I really thank all of them for having this wonderful program. And the participants, I was told that 200 plus registration was there. So the participants have also shown their sympathy and the quest for learning on corporate audits. I'm sure that with this lecture, the learning is over. Now you have to execute the learning. The more you execute, the better for the profession. With these words, I sign off. Thank you.
Learning is over, sir. Let the earning start.
Yes, sir. That's why.
So we have got a hint for another interesting topic also suggested by Chitley sir. So Aniket ji, please let us know your convenient dates. So
whenever Chitley sir invites, sir, it is my pleasure. And thank you so much. Thank you so much, Chitley sir. Thank you, madam.
Thank you so much. And I would not be out of place to make a special mention of the interactive participation from our participants. A big thank you to all of you. Thanks a lot. It encourages for organizing such interesting programs. Thank you. Stay home, stay safe. Thank you, sir. Thanks.
Thank you.
Thank you.
Thank you.
Thank you.